I think I'm visible now, right? Visible and audible. Can I proceed now? Hey, students.
Yes, sir.
Am I audible? Okay,
Yes,
okay, but
sir.
thank you. So I think we started the lease last section, right? Okay. So the lease finance is nothing but when the company they are not able to what do you call it, finance their or machinery or something else. Okay, in that time they may look by a leasing finance. It's nothing but they can use the property without purchasing the property. Or they can use the land or maybe machinery without using the without purchasing the machinery. This is called as a lease finance, and we were discussed on elaborately in the last class, right? Okay. So this is the concept of lease. So lease basically agreement between two parties commonly known as the lessor and the lessee. So lessor is the party who giving the property or the machinery, and the lessee is the person who taking the asset. Okay, for the payment of something, maybe yearly payment or maybe a monthly payment. Okay, for a period of some 10 year or 5 year or even 2 year also. Okay, well, so this is the concept of lease. These are the parties associated with the lease. Okay, so we all know the lessor and the lessee. So the lessor is the owner of the property. Okay, the lessee is the person who either lump sum or maybe periodic payment to continue the use of the asset. To for the use of the asset, he paying something that we call as a lessee actually, and the period for which the such right as conveyed by the lessor to the lessee is called as a lease period. It may be 3 years lease. It may be a lump sum you may be paid 5 lakh rupee and using the machinery for 2 year, 3 year, and 5 year, or maybe monthly you are paying, or maybe you are paying yearly. So these are all called as a lease period. How many period you are locking? How many period you went for an agreement? That is called as a lease period. In some cases, we may have a subleases also. Okay, sublease is nothing but there will be three party involved in that actually. Okay, so the person who purchased the machinery on the maybe from the bank, okay, and he is giving a lease. In that time, maybe if you are the lessor, maybe if you are the lessee, you need to pay the premium to, or you need to pay to the interest, or maybe we call it as a monthly or yearly repayment. It has to be done to the banker. In that time, it is called as a sublease also. Okay, so you are not going to pay the lease money to the lessor or the owner. You are going to pay bank. In that time, it is called as a sublease also. Okay, so apart from this, we have a broadly two category of financial lease or lease. One is financial lease, or we can call it as a finance lease. Okay, another one is operating lease. But there are prominently the two category of leasing we have. In the first category, lease is the transfer this substantial all the risk and reward incidental to the ownership of an asset. It's nothing but you will be considered almost like an owner. It is transferring substantial all the risk and reward to the incidental ownership of an asset. Okay, if you are taken a lease on a particular machinery in a financial lease category, you need to take care of the entire thing. But if this machinery is repaired or what do you call it, any major expenditure, you have to take care. That is finance lease. The person who is using, no, they have to take care of the everything. Prominently, that person has to take care. Okay, in that time of lease, it is called as a financial lease, and it is having some condition also. But moreover, it is fulfilling majority of the life under the financial lease. Let me take like this. So assume that we all know the car usually have some 10 to 15 year period of life, right? So if you are taking a machinery, maybe if you are taking in a car for a period of 7 year or 10 year or 9 year, in that time it is called as a financial lease because you covered majority of the life under the lease. Okay, in that time it is called as a financial lease. So there is another forms of lease we call it as an operating lease. It does not transfer the substantial all the risk and reward to the incidental ownership. It is nothing but we are using merely that machinery, merely that asset for a period of 6 months or 1 year or only for the particular activity I am required that. In that time, I may go by the operating lease. For operation angle only, I am going to use it. Okay, there is another name for capital lease is, sorry, financial lease is capital lease. Okay, so there is another name for finance lease is capital lease also. Again, these are all advantages we all know. So this is self-explanatory. So I'm not going to explain much on that. So as per the lessor point of view, it is full security because anytime the person who's not paying the money and if he's become a default and the lessor can repossess, he can take back his asset. So anytime it can be possible. And another one is there is a tax benefit because whenever you are purchasing a machinery, you need to pay interest, right? I think we all know about the tax bracket. I think you studied about the financial management. There you studied about the tax bracket. By assuming that you know that, we all know that tax benefit, how we are going to get it back. Okay. So it is nothing but when, if you are comparing two companies, let me put like this. There are two companies, A and B, and A is the company taken a loan for the purpose of the business extension. Okay. Assume that another company B, they are not taken any loan for the purpose of expansion. Okay, there are two identical firms. The profit of the both of firms are same, but firm A have a debt and firm B doesn't have a debt. In that time, if you are comparing the profit after tax, okay, that is residual amount, or we call it as net a profit available to the equity shareholder or the owner. In that time, if you are calculating, you may surprisingly sitting that the people who are having a debt, they can be able to reduce their expenditure. Okay. So they can say that this is our interest payment, and that is why we are paying this much as a profit. But whereas the people who have a doesn't have a loan, so they have to pay taxes more. People who have a less, people who have a what you call interest or loan, they will pay less taxes. So that is why it is called as a tax bracket. Okay. So you make it a tax bracket also. And there is a possibility of the high profit because you can charge the depreciation also. As long as you're charging depreciation also will be considered for your profit calculation. Okay. So again, the trading on equity can be happened because the reason is you are going to use a very lower amount of equity and a substantial amount you are going to borrow. In that time, you can trade between equity and debt. So that is also can be possible because you are taken a machinery on the loan or maybe borrowed amount. In that time, you may get a tax benefit. We call it as a leverage effect also. Okay. So these all can be happened. And the same way, these are the advantage of the lease. That is, the one form is it's a source of financing. Say, for example, if you need to purchase a machinery, but you don't have money, why should you need to pay for the machinery actually? If the same machinery is available for the lease, you can pay periodically. No, assume that the value of the machineries are 10 crore rupee. You don't have that 10 crore rupee, but you need to use that machinery. What we can do in that time? We can take the machinery on the lease basis. Monthly, you can pay some 5 lakh rupee for a bit of 10 year or 15 year. Until your requirement, you can use the machinery by paying some minimum amount. Okay, so it is how it is acting as a source of financing and no dilution of ownership. That is again very important part. So it is nothing but when you require money. Okay, when you going to extend your business, say for example, you have operation in Pondicherry only, but you are going to extend your operation in Chennai. Assume that you require another 10 crore rupee. In that time, what you can do? Either you can borrow money or you can call one of your maybe in a few friends and ask them to invest money in your business. If in that time, what will happen? You are getting money from your friends or maybe in a when you call relatives or it may be in a private partnership or maybe public limited company also. In that time, you are extending the number of owners. Earlier you have only 5 crore rupee. Now when you require 20 crore rupee, meaning that time you may issue fresh share capital. By issuing a fresh share capital, you may lose your control. Okay, that is when you are going by a purchasing of a machinery, you may lose your control. Whereas if you are taking a lease, because you are not going to pay lump sum. You are going to pay only on monthly or yearly payment. So that you can take from your business itself. So in that time, no dilution can be happen. Okay. Again, this is a less risk. The reason is one, the machinery is out of date. You can simply replace because you are not the owner of the machinery. Okay. So one fine morning you can came to know that there is a new updated machines are available. Why should you use this machinery? You can come out from the this old machinery which you taken as a lease, so that at all can be possible. Okay. So these are all advantages and for the what you call the laser. Okay. So no loss control also. Again, there is a tax benefit also. Okay. Again, you can take this machinery and you can sell back also. These all can be happen for the lazy angle also. And these are the limitation for the leasing actually. And certain machinery, there is a restriction for the use. So there may be what do you call that? You can use only for 6 hours or maybe 10 hours, or you can use it only for the particular purposes, or you cannot alter anything in that machinery or the property. So that type of restriction you may get when you are using a leasing, because it is not your property. You cannot enjoy the owner benefit. Okay, owner all the having all the right, no. But whereas I'm not a owner, I can use the machinery, but I cannot take any what do you call it, maybe alteration or maybe as per my requirement. So that is not possible. So sometimes it will be called as an high payout ratio because you are paying substantial money. Okay. So it will be huge money also. And no ownership for the lazy. So lazy will not get any ownership of the machinery. So these are the restriction of or the limitation of leasing financial. Okay. With this, we'll move on to the certain problem actually. Okay. Listen carefully. A Excel transport needed truck for which it is considering the following two options. Okay. The first option is buy the asset at 3 lakh and borrowing the amount at a 12% interest. Repaying same with together interest of in 4 equal annual installment. Okay. So what they are going by? The first one is they can buy the machinery which is having a worth of 3 lakh rupee with the 12% interest they can pay and 4 equal annual installment. Okay, the second one is acquiring the asset on the lease repayment of annual lease rental of 90,000 rupee per annum for the 4 year. Okay, so we need to suggest the firm follow the straight line method of depreciation under the income tax bracket is 30%. Okay, the life of the asset is 4 year only. Which option will be better for the firm? Whether purchasing machinery is the better going by lease is the better. So that we are going to conclude. You are able to follow me up. Okay. So there are two options is given. One is taking a machinery at 3 lakh rupee. Okay. Another yearly you can pay 90,000 rupee for a period of 4 years. Okay. So 90,000 into 4 years. 3,60,000 rupee. It's look like a 3,60,000 rupee, no? Right? But whereas you can pay 3 lakh rupee and hold the machinery. But look like it was 3,60,000 you're going to pay in the lease, but whereas you can in the asset, you can buy 3 lakh rupee. So we are going to consider for now. How it is going to be considered. Okay. So this is you should be very careful. The first one is the applicable discount rate. Okay, because even though the interest rate is 8%, 12%, we are going to consider only 70% of the 12% is 8.4. The reason is you may get a tax bracket of 30%. I said no, people who have purchased the machinery on the borrowed amount, so they can pay lesser tax. At the extent of how much they can pay lesser tax, 30% they can pay lesser taxes. Okay. So that is why applicable interest rate, that is discount rate, is not at 12%. It was 8.4%. Is it clear, Appa? Okay. So in the lease option, they are working. What is the lease option actually? present value of the after tax lease rental, that is 90,000 rupee, multiplied by 1 minus 0.3, because lease rental is an expenditure. Okay. That expenditure you can show in your profit and loss account. Remaining amount only you can going to pay taxes, not a entire sales revenue. Okay, this 90,000 your expenditure, and it can serve your profit also. How much it can serve? The 70% it may serve. Okay, so that is why we are going to calculate this much. Okay, 90,000 is my expenditure, but after considering this, it is supposed to be 63,000. Is it clear about what I'm telling? 70% of the 90,000 is 63,000. You are able to follow me up? Why we are taking that only? The reason is only 63,000 is your cost, not the entire 90,000, because 30% you are going to save from tax in. So that tax I'm taking here, the 63,000 is your yearly payment. That has to be multiplied by 8.4 percentage of the annuity factor. That is present value of interest annuity factor. How much it is? 3.2828. Okay. So, because since it is uniform, no, because every year you are going to pay 63,000. Okay. So, 63,000 into 3.2828, you make it a 2,06,816. Either you can go by this method, or you can go by this way also. That is lease rental. I'm going to pay 90,000 rupee for the 4 year. Lease rental after tax bracket is just 63,000 for the first year, second year, and third year, and fourth year. I'm going to calculate 8.4% interest. That is a discount rate. So first year, second year, third year, and fourth year, if you are sum upping, that value is 3.2828. Okay. So each year I'm going to multiply 63 into this amount, 63 into second year PV value, 63 into the third year PV value, 63 into fourth year PV value. So that value equal to how much? 2,06,816. It is nothing but when you going by a lease. Okay. What is the cost to you? It is just 2,06,000 only, not a 3,60,000, because we are going to make a payment by today. Today rate I am calculating, it was just 2,06,000. Same way I'm going by the second option, buy option. Okay. So what is your buy option? Annual installment is 3 lakh rupee divided by, that is present value of vanity factor. But that is, so you may get almost roughly, that is 3 lakh divided by the 12%. If for the period of 4 year is this much, but that is 3.037. So 98,782. Okay. So that is what your buying option cost. That is EMI is 98,000 you are going to pay for a period of 4 years. First year 98,000, second year 98,000, third year 90. Like this you are going to pay 4 equal installment. Okay. So now we are calculating the interest and the savings also. Okay. So 3 lakh we are paying in the first year. That is our outstanding amount, because since you are borrowing, your outstanding is 3 lakh rupee. Interest at 36%, sorry, 12% mean for 3 lakh, 36,000 is interest, and this is my installment. So 98,782 I'm paying. In that, interest is how much part? 36,000. Remaining amount I'm paying towards principal. Okay. So remaining the outstanding principal, 2,37,218. That for that I'm going to calculate interest for a period of 1 year. This is the interest portion, and this is the second year EMI. From that I'm deducting. This is the second year principal I'm paying. Okay, 98 I'm paying. First year 62,000 I'm paying towards principal. Second year I'm paying 70,000 towards principal. Third year I'm paying 70,000 towards principal, and the fourth year I'm paying towards in principal is 88,000, because our outstanding was very high in the initial period. That is why we are paying 36,000 first year interest, 28,466 you are paying in the second year. Like this, your interest are coming down, and principals are keep increasing. Reason is we are paying substantial amount on later days. Okay. So this all we know about how the EMA calculation. Okay. And why we calculating? Because we need to know how much we are paying towards taxes. Sorry, interest. First year I'm paying 36, 28, and this is for. Okay. For that I'm going to calculate 8.4% because even for your interest also you may save your money. What extent I can save money? 12% is my interest rate. I'm going to take only 8.4% of the my interest. How much it is for? Even though you are paying 10,800, the cost to you is just 9,967. Like this, you are. This has to be multiplied like this. 10,800. This. Okay. So like this, you are multiplying. This is your PV tax value. Okay. 24,000 is the savings of the tax, the present value of the savings of the tax. Okay. So now we are going to calculate the depreciation also, because since it is the depreciation also you can save your money because that is your expenditure. That extent you can save from your machinery. Okay. So 75 for the year 75,000. Tax saving is 22,500. Okay. That is 70% is 30% is tax saving. 75,000, 30% is 20,500. And for that, I'm calculating. So the PVF tax saving is how much? The first year, second year, and third year. And the total is 73,864. Okay. So now we calculated by the what you call the leasing option, and we are moving on to the purchasing option also. Purchasing option we calculated like this one. Okay. So the present value of the installment is how much? 3,24,282. And even though you are paying this much, and we are deducting the tax amount, tax savings we deducting. Because of interest, we saving 24,000. Because of depreciation, we saved 73,000. Total expenditure is this much. That is 98,000. 4 year I'm paying. Okay. Even though I'm paying this much, and the net amount I'm paying. Now the net cost for me is 2,26,000. Okay. That minus I'm going to compare with this one, the buying option. Buying option is 2,26,000, but the leasing option is just 2,06,000 only. So which is better for you? Because 2,06,000 is better for me. So leasing is the very less when compared to the buying. So it is better to go by a leasing option, not by a buying option. Because buying option, 20,000 you have extra cost. Okay. So this is how we need to evaluate. Okay. Same way it will keep continuing. So with this, we are moving on to the second portion, that is venture capital.
So, excuse me, sir. Sir,
Yes.
these
Yes.
kinds of problem will be coming, sir.
Yeah, you can expect. You can
They,
expect this type problem can come. Can come. We
will they
cannot give
give
a
the
guarantee, but it,
discounted
it can
value?
come.
Mm. Will they give
Yes,
discounted
yes. We
value?
need to. Yes, ma'am.
Mm. Will they
Can
give
you come again
discounted
once
value,
again?
sir? Will they give
Yeah,
discounted
it
value, sir?
depends. It depends. It depends. So this is how we need to evaluate the investment proposal, because we are going to take a decision by today, but the cash flows or cash outflows going to happen after some year, 5 year, third year. So in that time, surely we have to consider by taking a time value of money by considering a discounting factor, because decision is going to be done by today, but the cash inflows are after 5 years. How we can equate? Today 1 lakh is no more equal to the 5 year 1 lakh rupee. So I need to calculate the 5 year later 1 lakh rupees today worth. So that time we have to use the discount rate only. It depends, it depends. Here also they are using actually. It is very basic problem. One it was taken from the CA material actually. So once you understand that problem, this problem is nothing for you. Okay. So with this, I'm moving on to the second unit part. That is venture capital. Okay. So we'll move on to the second item, the venture capital. I think how many of you watched the Surare Potter movie? Pa? In that movie, maybe what do you call it? Surya maybe have an idea to having a starting to venture capital, right? So you have an idea, but you don't know where to get the money. Okay. In that time, he was approaching what they called some the contributor. Okay. So some capital contributor. Okay. In that time, it is called as a venture capital. No, same we are going to apply here also. So venture capital is nothing but we are going to get a capital from a good company, maybe in a well-known company. Okay. So they can help our entrepreneur. In that time, it is called as a venture capital. Clear? So venture capital is nothing but I know idea to start a business. I don't have money to start a business. In that time, you can go by a venture capital. Okay. So entire your business can be financed by either one firm or maybe in one or two firms. This is called as a venture capital. So capital is the most important factor for any factors of production. Okay, so this is we can go. It is venture capital is the form of equity financing, specially designed for funding high risk and reward project. Okay, the reason is why it is high risk and high reward project because it doesn't know. Nobody knows whether this business is going to get a profit or not, whether the business is going to give a what do you call it, going to pick up or not. But it is pick up to mean you may get a high profit. That is why it is called as an high funding project, and at the same time it was getting a high reward also. Okay, so it was definition is given here. Venture capital is a providing a seed, a startup, or the first stage of financing, also called as a funding. Okay, the expansion of a company. It may be for any reason. So it may be a seed financing. Even we have nowadays startup government itself giving us some finance actually, but maybe listen about from 10 from the year before. Okay, so in that time there is no that much startup funding. Okay, so you may get a money from your co-venturer. Okay, so a particular company may give a money to start a business. This is all called as a venture capital, and venture capital these are the characteristics. Okay, the first one is it is going to long time horizon because once you venture the money into the new business, or maybe you started the business with the what you call new business, you cannot get a money immediately because any business you are going to start, it will take some time to settle. Okay, so until that you need to wait. If you are going to liquidate your money, it cannot be possible. Yesterday I gave a money, you cannot take back the money immediately. Okay, you need to wait for at least some 5 year, 10 year if you are required to take money back. Okay, so this is called as a long time horizon. Okay, again, second one is lack of liquidity because you cannot take back your investment immediately. Assume that from ABC company wanted to invest in a venture, but ABC company cannot take money immediately, even though they are required. Okay, because it was invested in the some other form, you cannot get back the money immediately. So lack of liquidity is the second problem. The third one is high risk because nobody knows whether this business is going to be give a profit. Whether nobody knows whether the business is going to be success. Okay, so because it is a new idea, it may pick up or it may not pick up also. In that time, it was high risk. Whenever you are taking high risk, there is always you may get a high return also because this is a new idea. If the consumers are satisfied, you may get a high profit because you are the first one in entering that type of market. Okay, so can you imagine maybe 10 year, 15 year before food delivering app like a Zomato and what do you call that? I mean, Swiggy and so we cannot imagine those days, right? How this is going to happen because you are not running any hotel. Maybe in a hotel wala can supply food. It is easy. So there was third parties, they are supplying, they are connecting a customer and a hotel. How it is all happening? So these are all called as the startups. So can you think from the what they call the promoter angle those days 20 years before? How it is possible? How you can get to know the hotels? How you can connect to what you call the customer? So now it is possible, no? Can you imagine from that day onwards? So these are all called as an high risk capital. But I have some idea, but I need to start a business, no? So we need to get a money. Without money, how we can start the business? So in that time, it is all called as a startup financing or maybe in a venture capital. Certain people will give a money for the business. Okay. Again, you are participating as a owner, not a debenture holder. Okay, because owner will get a profit, high profit, only when companies are earning profit. Okay, until that time, equity owner or the equity shareholder has to wait. That is, it's called as an equity participation because venture capital is not a borrower or they are not given money to your business. They are participating in the form of equity shareholder. Okay, again, they can also participate in the management, even though if once they're given a money, they can participate the management decision also. Okay, so any decision you have to very important decision is a policy decision you have to take with the approval of the venture capital. Okay, these are the characteristics. And then we are moving into the method of venture capital. So in that there are various methods here. The first one is seed money financing. Seed money finance is nothing but very early stages. Okay, very early stages. Even for coming up with an idea. Okay, for that if you are financing, this is called as a seed money financing. Okay, it is not, the business is not started very early stages of the business. We call it as a preliminary aspect of a business. Assume that you are going to start a yeah, what they call it, an online food delivering, maybe in a business. So what are the preliminary things you are required, So maybe designing an app and maybe communicating with the what they call the buyer and connecting with the banking. So these are all called as seed money. For that you are giving a money mean it is called a seed money. Okay, it is very early stages. Second one is for development also. So once the business is started, okay, and it is okay now for the purpose of enhancing, for the purpose of expansion or the development of the business, if you are contributing, it is called as a development financing part. The third one is we call it as a later stage financing. So okay, later stage financing is nothing but, so business are started very long back. Okay, it was expanded also, but third stage the business want to go by a public issue. Okay, in that time, if you are contributing, it is called as an later stage financing. Okay, so when they're going by public finance, okay, so when they're going by in a public issue, in that time, it is called as a later stage financing part. Okay, so here we discussed about there are three forms of financing prominently. That is seed money financing, development financing. Yes. Sorry, later stage financing, and we call it as a turnaround also. It is nothing but a C company may taken over the providing it two important inputs from the capital and management. It's nothing but they can take a sick company also. This is called as a turnaround financing or turnaround stages also. In that time, it may happen in two ways. One is financial turnaround, another one is management turnaround. Okay, when the company is able to improve its condition financially, it is called as a financial turnaround. Due to the financial assistance, they may go by enough venture capital. Assume that you started a business very well, it is went, but due to the certain vertical, due to the COVID issue or due to certain economic crisis, your business are sick now. Your business is very weak now. In that time, if you are taking a money, it is called as a turnaround venture capital. Okay, turnaround is nothing but due to the certain financial strain, I'm not able to continue my business. So you require money for turnaround finance. Sometimes we may have a management financing also. That is management turnaround. It is nothing but you are lacking certain experts. Don't have a what you call proper human resource department. You don't have a proper what you call technical department. In that time, if you are taking your own what they called methodology for your own managing your business, it's called as a management turnaround. Okay, so this is how we discussed about methods of venture capital. Again, these are all we called as modes of venture capital. How the venture capital given? It may be equity completely. Okay, equity all we know, right? It will be called as a pure owner. Okay, so you will get all the advantages like what the owner will get. Okay, so it is the owner firms. Second one is quasi equity. Okay, so quasi equity is nothing but until some time it will be considered as an debenture. Later on, it may be converted as an equity share. Okay, so quite some period it will be debenture. On later on, it will be an equity share or reverse also. In that time, it is called as a quasi equity. Okay, is it clear? Appa? So in that way, you may get a venture capital. So this. So with this, we are this is all venture capital happening in the country. Okay, what are the venture capital? It is very old one only. So with this, I'll start with unit number 5. So maybe next class, maybe next, I don't know tomorrow, I think. So maybe next class we'll discuss on certain question paper. I'll try to conclude the unit number 5 in the next class, and we'll start the question paper discussion also in the next class. Okay. So with this, I'm moving on to the 5th unit, that is financing strategies with the innovative and hybrid security with the option financing and others. Can I start with this? Okay. So we are moving on to the unit number 5 now. Okay.
Hello,
So
sir.
listen, in a
I just
broad classification of group, yes, somebody said something.
yeah. Hello, sir. So just one thing. So as you're planning to finish the next chapter in the next class, just wondering if you have a notes or a PPT, could you share that also in the next class? Or maybe I can.
Today I'm taking lease finance. I'm prepared a PPT, so that you can. But what I highlighted, no, so that you can. I was referring from only books only, okay, because this is keep changing every day. So you can instead of referring from some other, you can refer the books. That is better because the questionnaire will be taken and the book as a reference. That is why instead of preparing a PPT, I was taking by in a book itself. What are all important that I'm just highlighting and keep going. I'll share the
Yeah,
PPT
but
what I'm shown today. Please finance, I'll show you.
yeah, if you can, sure, sure. If you can prepare PPT and just share a link, Google Drive or anything, I think that also will help because
Okay.
that helps in a quick summary of the things.
Okay,
Thank you.
sure. I'll share. Okay. Okay. So we are moving on to the 5th unit, the financing strategy. The first one we are discussing on innovative and hybrid security. That is 5.1. So in a thing from 20, 30 years before, in that days, we have only two forms of securities. 30, 40 years before, if you are considering any corporates, they may get a two forms of money. It may be equity, or if not equity, they may be go by a debt. So the prominently, if you are referring any companies, they can raise some money combined of both debt and equity. Okay. But nowadays, what happening? But they are combining something. Okay. So I think we all know about what do you call hybrid fruit, no? Right? Hybrid vegetables. Same way we have a hybrid securities, but it's nothing but taking the two different flavor and combine by getting a new product. Okay. So we are nowadays bank what they call the biotechnology vegetables, right? So it is nothing but we are taking the characters from the let me take. Nowadays we are able to get a what do you call it? Yeah, bigger size Goa. How this all happening? So they are going with some biotechnology, right? Because they are taking the character from some other vegetable, okay, and they are coming with a new own vegetable. No, so there is nothing but called we call it as a hybrid because it is combining two securities, are combining two vegetables, two fruits. Same way, hybrid is nothing but combining the traditional form of two forms of security like a debt and the venture. Okay, so debt and equity, and coming up with the new one or new forms of security. That is called as an hybrid security, combining both and coming with a new hybrid securities. Okay, it will be having the characteristics of debt and equity. Okay, so that is called as an hybrid securities. In that, these are the forms we have. Okay, the number one is we have a preference share capital. So we all know about the share equity share capital. No, what is equity share capital? So those people as an actual owner, they'll get a money. That is, they may get a share of profit after paying interest, right? So if the company have a profit, only the equity holder will get a profit. But what about the preference shareholder? So we know about equity shareholder. What is the preference shareholder? So these people will get a preference, not like an equity shareholder. Equity shareholder will get only residual money. What is left over after paying to the debenture holder or the loan or maybe creditor, what is left over that can be given to the owner. Okay, but whereas the preference shareholder, these people will get a preference in paying a share. Okay, so this is called as an combining the equity form and debt form. Okay, equity is nothing but you may get a dividend. Company may give a dividend. Sometimes even they are not giving dividends, you cannot ask because even the company have a profit also they are not going to declare dividend, you cannot ask. Okay, but whereas in a preference shareholder, it will be considered as equity shareholder. At the same time, you may get a dividend also. Okay, so that is called as a preference shareholder. Again, the preference shareholders are many forms. These are the attributes and features of a preference shareholder. Prior claim of an income of an asset. Okay, and the second one is the cumulative dividend. Prior is nothing but he will get a priority. He will get a first shares holder. Second one is cumulative dividend. It is nothing but these people will get a cumulative. Assume that the company started in the year 2018. Okay. So first 2 years, they don't have any profit. For that time, they are not paid any dividend to the preference shareholder. But when they are having a third year profit, in that time, assume that they have to pay cumulative dividend because first 2 years they are not paid because of there is no profit. Third year they have to pay cumulative for the first 2 to 3 years. This is called as a cumulative preference shareholder. Okay, so this you in that way also you may get it. Whereas if it is equity shareholder, they cannot get back the previous year dividend. Okay, only if you have a profit in the particular year, company declared only that time they may get a dividend, but they cannot get a what do you call it? Maybe in a previous period also. So the next one is redeemable preference share in the form of redeemability. Okay, so usually the preference share have some limited life or fixed maturity. Okay, after that it must be retired. Okay, if it is an equity shareholder, There is no retirement, there is no fixed maturity. Until the company is surviving, you will become a equity shareholder. If it is in a preference shareholder, it will be 5 years preference shares. First 5 years you will get a preferred dividend, and the 6th year the company may redeem your share. So they can give back your money and they can revoke the what you call preference shares. So these are all called as a redeemable preference share. Clear up? You are able to follow me? So we are discussing on hybrid forms of security. Hybrid is nothing but combining the debt and equity, coming with the new own securities. Okay, combining debt and equity, we are taking a debt flavor in the equity share, and this is become a what do you call it? Debt based equities. Okay, debt based shares. Same way, we are going to have. Okay, so these are all their characteristics, and there is a fixed dividend will be there each year. You have to pay. If it is a 10%, 10% is a share capital you have to pay as a dividend. Okay, and it is a convertibility. Sometimes it may convertible in the form of equity share, or maybe in a debenture, or maybe any forms. If they are mentioned, so you need to wait for that period. Once that period is over, it will be convertible in the form of debenture or something. Sometime the preference shareholder may get a voting right. Not all the preference shareholder. Certain preference shareholder may get a voting right. It depends. Okay. So that is why it is given here. So it does not carry any voting right. But however, the preference shareholder dividends are earlier in respect to 2 years. In certain cases, if they're mentioned specifically, okay, in that time, the preference shareholder also may get a voting right. Okay. And preference may be participating. The participation of can be also done. That is, preference capital may be participating and entitled in the participation in the surplus profit. Okay. If any, that profit is after payment of preference dividends and equity for certain specified rate. Okay. It is nothing but even they are having extra profit after paying a preference dividend and equity dividend, in that time also they can claim. The preference shareholder can claim the dividend after paying the both the dividend also. Okay. So these are the advantages of the preference shareholder. These are all self-explanatory. So that I'm not discussing actually. So let me recollect what we discussed as of now. So the class we started, no? Unit number 4, we started about the leasing financing, right? The lease finance we were discussing on various forms of lease, right? So what is the lease? Parties involved in the leasing, we discussed it. And various types of lease we discussed. Prominently, we discussed operating lease and financial lease. How the leasing, as per the lazy point of view, how he can take a decision we discussed about. So we taken a missionary which can be taken in the either paying 3 lakh rupee with the EMI, taking the missionary at 90,000 rupee for a period of 4 years. Okay, so in that way we collected, we taken, and we evaluated both actually. We are consider the vertical PV value also, because we are making a payment by today, but the benefit or the revenue we may get it after 1 year, second year, and third year. That is why we discounted the money into the certain factor, and we arrived at the 8.4 no, in that example like that. So even though it is 12% interest rate, we taken only 8.4. We said about the tax bracket. So the tax bracket we calculated, and we come to a conclusion taking by a lease is better, because monthly you are paying 90, sorry, yearly you are paying 90,000. This cost is just 2,06,000 rupee. Okay. Whereas if you are going by purchasing, it was 2,26,000 rupee. and there is a 20,000 rupee you may get a benefit when you are going by a leasing. Okay. So this is how we work it out, and we come to a conclusion going by leasing is a better option for the this situation. Okay. Same way we have to evaluate by you may get a problem in that type of categories also. Okay. So the same I'll continue in the next class. Maybe the advantages and the limitation we can discuss it. And with this, we can move on to the next item. Debenture we can discuss. Okay. So if at all you have any doubt, let me know. Otherwise, we can conclude the today class.
So you told me about the problem, no, sir. Is it in case study? Will it come in case study?
Yeah, surely case study, there is a financing also problem. Lease finance also can become.
Oh,
Any
okay,
problem
thank
they
you,
may
sir.
ask, or they may take any scenario. Scenario based, they may given a situation. All it is depends.
Mm,
Anyway,
thank you, sir.
let me discuss in the next class. I'll take a question in the next class. In the next class. Okay. Okay. Thank you. Thank you. We'll discuss in the
Thank
next
you.
class.
Good morning to all. Good morning. Good morning.
Good morning, sir.
To start the class, screen is visible.
Yes, sir. It's
Yeah.
visible.
Okay. The paper name is Merchant Banking and Financial Services. Already we have to discuss it two units. Now we are discussing a third unit. Merchant first unit is the Merchant Banking and Financial Services, and second unit Merchant Banking. And we have discussed an important questions about the major players in merchant banking and the issue management activities and procedures, that is TIG issue guidelines. And third unit factoring and factoring services. In continuation of the third unit, one more topic is there, that is real estate industries and housing finance. In India, the real estate industries play a vital role in the development of our Indian economics growth and development. The contribution of real estate India is about 5% to our gross domestic product. Normally, the real estate investment is a long-term investment. In case I were to purchase shares, gold, all these things is short-term investment. But you have to invest it in the real estate. That is, your focus is mainly on long-term investment, and also it is a durable assets. And the life of the asset, like the life of the building or any other assets, you have to invest in the real estate industry is much longer than any other financial asset. Real estate is a physical asset. In case you have to invest it in securities, bonds, shares, or mutual funds, insurance, or you invest in banks, all these things. This is the financial assets. But in case of real estate, it's a physical asset. This is longer than any other financial asset. At the same time, the realization of land and building takes much longer time. because it involves complicated legal procedures and high transaction costs. In compared to other investment, you have to go for investment in real estate investment. Procedure is also very high. At the same time, the transaction cost is also very high. So it involvement of the long term. It purely focus on long term investment. It's not like the short term or medium term investment. Real estate industry is a long term investment. Next, the real estate assets classified based on three important points. One is purchased occupied property. You go for real estate investment, your focus is on three ways. One is purchaser occupied properties. Another one is income producing properties. And next one is the property developed for sale. The first one is purchaser occupied property. That is, for example, as you are an investor, you are going to purchase a property for his own purpose, for his own residential purpose, or for his business purpose. It's called purchaser occupied property. Your focus on your investment is mainly for your residential purpose or for your business purpose. That type of investment you are going to underwent, that is called as purchaser occupied property. That is the person who purchases the property for his own use, either for his residential purpose or for his business purpose. The second category is income producing property. That is the property purchased for the purpose. That is our goal is you are going to lease your property or renting. You are getting income generated in the form of monthly return, 3 months return, or 6 month return. So your focus is for an income basis. So that type of investment, if you are going to invest in real estate investment, that type of income producing property. The first one case is you have to invest for his own purpose, your residential purpose or for your business purpose. Second is your focus on generating regular income from your investments. The third one is property developed for sale. This if the purpose of purchasing this type of property is to sell to other for profit. You have to purchase the profit, you have modernizing or something, or you are underwent, and you sell out of this residential property getting more profit. The third one is your focus on profit. Second one is focus on income. The first case is your own residential purpose and right. So normally three categories of investment in underwent real estate is purchasers occupied property, income producing properties, and third case is property developed for sales for making profit, purchase of building and sold to others and getting more benefit on the purchase of this property. So three way you have to categorize on real estate investment, that is classified your investment in real estate asset. And the next one is factors that makes real estate attractive. Why the investor is there is lot of investment channel is there. Why the investor is going to invest in real estate? Maybe it's a focus on long term. That is one of the major important point. And at the same time, not only for the long term benefit you are getting on your return on investment, at the same time, the demand for this industry is increasing year by year. There is a demand is very increasing in these industries. At the same time, it generates two types of income. One is capital gain is also. You have to purchase the land and sold on summer time for 3 years. After 3 years, you are getting capital gain. At the same time, meantime, you are getting regular income on rental basis. So you are getting two types of benefit from real estate investments. One is your capital gain. Another one is regular income. That is rental income on your investment. And another one is that is regular income, that is way for regular income through lease or investment. And same thing, these industries progress, that is the revolution of real estate, this is increasing here due to most of the MNC companies is started, especially after liberalization. This industry progress is very high. More number of companies are coming from MNC companies started from metropolitan cities. The real estate industry is also booming. Benefit of real estate investment, that is the first one is the tax benefit. There is a tax exemption subjected to certain conditions on profit. That is a capital gain arising from sale of land or building. That is the tax section. These encourage the investor to invest in real estate sector. There is some sections are provided by some exceptions are given by Income Tax Act on basis of the getting capital gains on sale of lands and building. And another one is housing loans are available at the lower rate of interest. in compared to other type of investment, you are getting other type of loan, you are getting housing loan is getting lower rate of interest. Hence, middle class people are, they can easily purchase his own house. And next one is the rental income. Investment in commercial premises generate more rental income besides increase the value of investment in the premises. Today's the rent generation of rent for this investment is very high. And the last one is the yield of investment. The yield of investment in real estate is exorbitant, whereas the stock market is highly volatile. So now there is number of channel of investment is there, but there is volatile. There is uncertain is prevailing. For example, in case you go for investment stock market, there is uncertain, volatile movement. So at the time, the safer investment is real estate investment. They were getting more benefit in compared to other type of investment. It is very safer and easily safer investment is very, so there is yield of investment is very high in real estate investment. So these four major benefits of real estate investment. One is tax exemption, second one is lower rate of interest, third one is rental income, and fourth one is yield of investment. Next one is, what do you mean by housing finance?
So
Housing finance is
one
simply,
question, sir.
hello, hello,
Hello.
ah,
Yeah, one
yeah,
question. So in terms of, as we are saying that it's a good investment, right, in terms of rental and yield. But if we practically see, right, so in the current market and everything, right, so with the property price and everything, the yield is coming only is between like 2 to 3%. So do we still consider that as a good investment because that's not even
but
beating the
it's a safer
inflation?
investment. Yeah, yeah, but it's a very safer investment compared to in case you go for investment in long term, your investment is also very high. But which one is safer to you? The market is volatile.
No,
For
but
example, you have to purchase a blue chip company share is also okay, no problem. But return is very high. But at the same time, the risk is also very high. But in case of real estate investment, the risk is very compared to stock market, the risk is very low. That's
no,
why.
no, with the stock market is okay, but it's not even giving the fixed FD rate, right? So because the inflation is
Yeah.
around 6% and the rental
But
yield is three
more than
percent.
the FD rate, relative gain more than the FD rate is there. Normally, you go for purchase
Is
one
no?
land from a metropolitan cities like Chennai or Mumbai or something. The return is very high in compared to FD. FD rate is maximum 8% or 5%. But in case of a real estate investment, your capital gain is more than 24% to 36%. Okay.
Yeah, at some places
Hello.
it might be, but not a general thing, is
Yeah,
in my
yeah, yeah, yeah.
opinion.
That's. Yeah. I'm also agree. I'm also agree. With that. Same thing. Right, right, right. Yeah.
Okay. Thanks.
Move on to next one. Yeah, housing finance. Yeah, housing finance. The simple meanings about housing finance is a fund-based financial services. Housing finance means the loan provided to individual for the purchase of house, apartment, and land. So, housing finance is simply explain about the loan provided to individual for the purchase of your house or apartments or land. In India, the housing finance was largely provided by government till mid 80s. But in the year 1988, the Reserve Bank of India established a fully owned subsidiary banks, namely Housing National Housing Bank, exclusive for housing finance. It's a NHB, National Housing Banks. Normally, this bank provide five kinds of loans to individuals households. First one is a home equity loan. That is, the loan is provided to customer by mortgaging the existing house property at the market value for any purpose. That is a home provided to customers based on mortgaging. Second one is home purchase loan. This loan is provided exclusively for the purchase of apartment or individual building, both new and old building. You have to construct new building or you have to purchase the old building is also, that is home purchase loan. Third loan is land purchase loan. Loan is provided for the purpose of land and the construction of residential house. You have to purchase the land and construct the residential house. The fourth one is home extension loan. This loan is provided for construction of additional rooms, floors, or other facilities provided to the house. That is home extension loan.
And the last one is home improvement loan. It is provided for renovation of old house. You have already house, you have to renovate your house. That is provided by home improvement loan. So there is five kinds of loan provided by National Housing Bank. That is home equity loan, home purchase loan, land purchase loan, home extension loan, and home improvement loan.
One question.
Next,
So these days,
lending.
people give a loan for the interior design also. So it will be in the extension or improvement.
Extension.
Okay, okay. And there is one loan I have heard, that is a loan against property, like like you might
That is
already
home equity.
have. Okay, got it. Thanks.
Lending practices of housing finance. That is, housing finance follows some guidelines for lending practices to lending to the household investors. The first one is interest rates. Normally, there are two types of interest rate system, namely fixed and fluctuating interest rate system. Under fixed interest rate system, interest is fixed for particular period of time. Beyond such period, interest may fluctuate based on Reserve Bank of India direction. That is, for example, Mr. X takes housing loan for a period of 20 years. Under fixed rate system, there is no change in the interest rate for the first 5 years, and it fluctuates thereafter based on the direction of the Reserve Bank of India. But in case of fluctuating rate system, the interest rate fluctuates frequently based on bank rate. The rate of interest differ under different sub-slab system based on amount and repayment period. So there is two types of interest. One is fixed, another one is fluctuating interest rate system. The second one is security. The title deed must be mortgaged with the lender for the security purpose. That is, after your loan amount is completed, then only the title is transferred to the uh, providers. So next one is processing fees. To meet the operational expenses, lenders charges, that is bank charges 0.50% of loan amount for processing housing loans. And the next one is EMI, that is equated monthly installment. It is a fixed monthly repayment of housing loan. Borrowers of the housing loan repay to his lender in the form of EMI over a period of time. But one case, the EMI amount depend on the rate of interest, loan amount, and the repayment period. The tenure of the loans can be reduced, increasing the EMI amount. The EMI cover both the principal amount and also the interest components. The next guidelines is pre-closure of housing loan. Ac- Accounts normally, the repayment period of housing loan may be depending on your terms and conditions like 5, 10, 15, 20 years or any number of years at the option of the borrowers. The borrowers can pre-closure the housing loan at any time, paying the balance amount in full. The lender charges, that is the foreclosure, before closing your account, foreclosure 0.5% or 1% on outstanding loan amount on the date of pre-closure of premature closure of the loan amount. That is charged by the pre-closure, that is foreclosure. This other name is called as foreclosure. So normally at the lending practices followed by national housing banks, you have to consider these points: interest rate, security, processing fees, equity monthly installment, that is EMI, free closure or foreclosure of housing loan. Next one is advantages of housing finance. What are the advantages? You are getting loan from NHB, that is National Housing Finance Corporation. That is, first one is, even the middle class people can become the owner of the property. As you are, the income is very low. You are not invested your money. You are not having the money. You are getting loan from banks and construct your building or purchase the buildings. That so even low middle class people can become the owner of the property. That is the one of the advantages. And a easy and convenient method for repayment. That is EMI facilities available for a housing loan with low interest rate is possible for borrowers. and the borrowers can get bulk finance the time of purchase of house, and the same can be mortgaged as securities, and it creates greater employment of both directly or indirectly. The development of the real estate industries, it creates the employment opportunities, especially for urban areas, and the demand for construction of materials like cement, bricks, sanitaries, all this product cost is also increasing. The housing finance is pay the way for infrastructure development, and it's available for tax exemptions, capital gain. All these things is also available for getting loans from banks. Next one is housing loan procedures. There is some procedures is for depending upon the banks, the procedure may be changes. This is a common procedure. Here is a step-by-step procedure for our home loan. The first one is application form. The second one is personal discussions with the banks and the growers. And third one is banks field investigation. The bank officer uh, visited physically on the basis of purchasing of land or building on thing. Credit appraisal bank and a loan sanction and offer letter, submission of legal document and a legal check, technical valuation checks, and finally registration of property document, signing of agreement and submitting post-dated checks and disbursements. That is next reason for growth of housing finance in India. What is a, there is a tremendous booming for real estate industries in India. What is a major reason for that? That is liquidity in the systems, lower inflation rate. But a lower inflation rate is not possible now. As per our theoretical discussion, we have taken this point. Lower inflation rate in India is not a lower inflation rate. Softer interest rate regime, housing loan as the lowest non-performing assets, and a legal framework is very easy. There is wider network, easily you are getting loans from banks, and customer-friendly product. These are the points where practically there is a lot of changes is there. But as far as the theoretical point of view, you have to discuss reason for growth of housing finance in India. But now the interest rate is also very high for housing loans. Inflation is uncontrollable. Inflation is also not any stable one. It's also booming, and it's not easy for getting loan nowadays from a banks. All those things. But as far as the theoretical point of view, we have to discuss the system is liquidity, easily availability of loan, lower inflation rate, softer interest rate regimes, housing loan as the lowest non-performing asset, the physical concessions and legal framework, all these things. And an important question is housing finance in India. For our examinations point of view, this question is repeatedly asking. So housing finance in India. In India, for a long, there was no proper institution for providing housing finance. During 1960, the central and state government brought various housing programs in order to relieve the congestion of population incited for urban areas. In this direction, the Housing and Urban Development Corporation (HUDCO), the Housing and Urban Development Corporation, was established in April 1970 to finance various housing and urban infrastructure activities. The total shares of HUDCO were subscribed by Government of India. That is, assistance of it provides mass housing schemes such as rural housing schemes, cooperative house constructions, urban housing schemes, cyclone shelters, land acquisition, sanitation, and slum improvement promotions and building technology. HUDCO provides the following housing refinance facilities to state government, that is state housing boards, rural housing boards, slum clearance board, development authorities, city improvement trust, municipal corporations, total panchayat and primary cooperative banks. And the next bank is Housing Development Financial Corporation Limited, that is HDFC. Later on, private sector is also entered into the housing finance, and the private sector housing finance companies came into existence in 1977, which is known as Housing Development Finance Corporation (HDFC) Limited. It is the first private sector housing finance company in India. It is one of the leader in the Indian housing finance market. The special features of HDFC are providing for in the form of home extension loan is provided, home improvement loan, short-term building loan, home equity loan, and land purchase loan. The list of other leading housing finance companies in India are State Bank of India Housing Finance, LIC, ICICI, IDBI, PNP Housing Finance Limited, Devan Housing Finance Limited, LGIC, and Canfin Homes Limited. And finally, the National Housing Bank. The National Housing Bank was established on July 9, 1980 under the National Housing Bank. It is wholly owned Apex Bank for Reserve Bank of India. The head office of a National Housing Bank is located at New Delhi. The main objective of this bank is to provide to promote a sound, healthy, viable, and cost-effective housing finance systems to cater all segment of the populations, that is rural, urban, all these things, and to integrate the housing finance system with the overall financial system. It provides loans to the housing. National Housing Bank is linked with cooperative bank, is also providing loans to rural areas, urban areas. So its main focus is it segment all the people of the Indias, and next one to promote a network of dedicated housing finance institute to adequate severe various regions and a different income groups, low income group, high income group, depending upon the capacity of the person. It providing loans to depending when the middle income class is also getting the up to the range of 10 to 15 lakhs. The range is 20 to more than 25 lakhs. So depending upon the different income groups, and to enlarge resources for the sector and channelize jump for housing, to make housing credit more affordable. And the main thing is there is a regulation is there to regulate the activities of housing finance company based on regulatory and supervising authorities derived under this act, to encourage supply of building land and also building materials for housing, and to upgrade the housing stock in the countries, and to encourage public agencies to emerge as facilities and a supplier of service land for housing. The organization structure is that it has the following departments handling the activities: regulation functions, refinancing operations, direct finance to the in needers, enabling processing, information technologies, resources mobilization, all these things. And finance functions of NHB, National Housing Banks, supports housing finance sectors by extending refinance to different primary lenders in respect of eligible housing loan extended by them to individual beneficiaries, giving project loan extended by the various implementing agencies, other agencies also. Mostly NHBC tie up with cooperative societies for the development of rural areas, and lending directly in respect of project undertaken by public housing agents for housing construction and development of housing related infrastructures. They guarantee the repayment of principals and the payment of interest on bond issued by the housing finance corporations, and special purpose for securing the housing loan receivables. These are the major functions is done by National Housing Banks. Is linked with the housing finance sectors. These are the major points we have to discuss about the housing finance. That is your third unit is over. Real estate industries, and move on to fourth unit, mutual fund. Yeah, you know very well that mutual fund is a well-known concept for all. A mutual fund is simply means a small sum of amount, the pooling of small sum of amount from the investor, and there is a fund manager is there. After screening all the risk and return factors, these fund managers are invest money to the capital market and getting return from the capital market, and why these returns in the form of NAV. So the mutual fund collects the saving from small investor, invest them in government and other industrial securities, and earn income through interest and dividend besides capital gain. So totally there is three persons is involved: investors, fund manager, security, that is invest in securities market, and return. The return is distributed in the form of NAV, net asset value. So the mutual fund collect the saving from small investor, invest them in securities, and getting return. The return is distributed in the form of net asset value. The Security and Exchange Board of India, that is Mutual Fund Regulations Act 1993, defines A mutual fund as a fund established in the form of trust by a sponsor, that is the fund manager, to raise monies by the trustees through the sale of units to the public. That is small sum of amount you are getting from the small investors under one or more schemes for investing that money, that collected monies from small investors invested in the security market in accordance with these regulations. So investor pooling their monies together collected from small sum of amount, choosing the securities in investments. So depending upon the risk and the return factor, the fund manager, based on its portfolios and the diversification of the investment in the capital market, and generate return from the investment and pass down to the investors. So simply means small investors is also enter to investment in the capital market. So there is a middleman is there. The middleman is the fund managers. So what is the objectives of mutual fund means? To mobilize savings of people, that is savings of people from, so that is a main motto. Small amount is also invested. Maybe in today's you have to invest at 50 rupees is also available for mutual fund, to mobilize savings of peoples and to offer a convenient way for the small investor to enter the capital and money market. So small investor is also easily entered to the money, enter to the capital market with the help of these mutual fund managers or fund managers, to tap domestic savings and channelize them for profitable investment. Collecting small amount from the small investor, there is a huge amount is there. That huge amounts are channelized them to the capital market, government security market or industrial securities market. So making of your small investment as a very good profitable investment. And to enable the investor to share the prosperity of the capital market, simple like the management is simply act as an agent, to act as agent for growth and stability of the capital market, and to attract investment from risk averse. Normally there is a three kinds of person is there: risk averse, risk taker, risk bearer. In case of risk averse, the person is not ready to take the risk. For example, the person is going to invest his fund in fixed deposits, banks, all these things are the risk averse. But the risk bearer means the person is taking as a little bit of risk, like a risk bearer investment in mutual funds, government securities, gilt edge securities, maybe sometimes gold is also. But the risk taker means the person is ready to take risk. Whenever there is a risk, there is a return. You are taking a high risk, you are getting more return. But in case of mutual fund, the risk averse, the person is not ready to take the risk for enter to the capital market, or the person is not aware about the performance and functions of the capital market, how the capital market is moving, how to purchase the shares. They don't know about the what is actually going on depending upon the economical situation, market situation. So that type of person are easily enter to the capital market with the help of the mutual fund. There is a trustee is there. The person is know all the facts about the capital market. So he's collecting all the monies from the small investors, and these monies are invested to the capital market and getting the return. So the small investor is also engaged in the capital market. So to attract the investment from the small investor, so to attract investment from the risk averse means the person is not ready to take the risk, but person is expecting return, but at the same time the person is not taking too much of risk. And finally, to facilitate the orderly development of the capital market, the free flow of money is possible only with help of the mutual funds. Mutual fund contribution is very high for individual investor. DII or DII, the individual investors amount is more than the mutual fund investment nowadays. Especially today's the market is very developed, very downtrend. In this situation, mutual fund money is very best for the small investors. Features of mutual fund: the mutual fund mobilize funds from small as well as large investors by selling units. In case of investing a capital market, there is a shares. Here, in case of mutual fund, there is an unit. That return is NAV, net asset value. And the second point is mutual provide ideal opportunities to small investors an ideal avenue for investments. So it's giving a path to the small investor is also entered to the capital market. And the mutual fund enable the investor to enjoy the benefit of professional and expert management of the fund. So there is an intermediate, there is a fund manager is there. He know all the facts of market risk, internal risk, external risk. He is well versed about the financial things, all these things, our economical things, situation, all these things, how to invest the money, how to save your investment. So the mutual fund enable the investor to enjoy the benefit of professional and expert management of their funds. And the mutual fund investments, the savings collected in a wide portfolio sector to maximize the return and minimize the risk for the beneficiaries. Whenever there is a return, there is a risk is there. But as in case you are invested in a mutual fund, the risk is very, very less in compared to investment in shares directly to the capital market. The risk is very, very high. But this is also having some risk is there, market risk is there, but the risk is very less. Maximum return we are getting and minimum risk. And a mutual fund provides switching facilities to investors who can switch from one scheme to another scheme. So once you are to getting a income based bond, you are to invested and you are shifted to other bond. For example, I purchased SBI. No, SBI shifted to within 1 3 months. I would shifted to Quant or a index funds. There is number of opportunities shifting your fund from one mutual scheme fund schemes to another mutual fund schemes. Various schemes offered by mutual fund provide tax benefit to the investors. Yeah, tax benefit is also available for investment in mutual fund. In India, mutual funds are regulated by agencies like it shares as the regulator is Security and Exchange Board of India. If you are going to purchase shares, who is the regulator means SEBI. Same thing like SEBI, the regulator is also SEBI is the regulator. The cost of purchase and sales of mutual fund is very low in compared to transaction cost, security cost, brokerage cost. Mutual fund is very low, but the expenses ratio is there. But in case of we go for purchase shares, debentures, all these things, the cost is very high in compared to purchase of the investment in mutual fund. And a mutual fund contribute to the economic development of the countries. The next one is importance of mutual funds. That is mobilize small savings. Yeah, mutual fund mobilize small savings from investors by offering various schemes there. These schemes meet the valid requirement of the people depending upon your investment. The savings of the people are channelized for the development of the economy. In the absence of mutual fund, these savings would be remain ideal. So the main focus of mutual fund is mobilize small savings from investor. That is pooling of investment from small investors, collecting all the small investment. The mutual fund manager, there is a large sum of amount. These large sum of amount is invested in your diversified investment schemes and getting more return. And second one is diversified investment. The small investors cannot offer to purchase shares for the highly established companies because high market price. For example, I am interested to purchase for Tata Motors, all these things. The share value is Kalyan's, Manapura, or something. All this, the share value is very, very high, 2,000, 1,500. I'm not. But in case mutual fund, the unit is very 100 rupees. So I am also enter the mutual fund provide the opportunities to small investor. Even a very small investor, the investor can enter the wide portfolio of investment with variety of securities. So the small and medium investors is also entering to the capital market with the help of mutual fund, provide better return. Yes, it is a huge funds can be mobilized from mutual fund industries. Because of this huge fund, the mutual funds are in a position to buy securities at a cheaper rate and sell securities at the higher rates and better equities at any time. You can be sold and convert into cash. Whenever investors require cash, they can avail loan facilities from the sponsoring bank against the unit certificates and a low transaction cost. A mutual fund is also having the cost is there, expenses ratio is there, but the cost of purchase and sale of mutual fund is relatively less, like brokerage fees, transaction cost, commissions are lower and a reduced risk. Normally, there is only a minimum risk is attached to the principal amount and also return of investment made in mutual fund. This is due to the main reason is the fund manager supervision, diversification, and liquidity of your units. All these things. That only the professional management. The mutual funds are managed by only professionals. They are well trained. They have adequate experience in the field of investment, security market, portfolio management, and economical situations, both micro and macro aspects. All these things is so very well that so thus investors get qualifying services from mutual fund. The individual investor would never get such services from security market. And offer tax benefit is also there. Some mutual funds offer tax benefit to investors. For instance, under section 80L of the income tax act, a sum of rupees 1,000 received as dividend from mutual funds, and in case of UTI is deductible from gross total income. Some tax benefit is also available under 80L of the income tax act. And support to the capital market. The savings of people are directed toward investment in capital market through mutual fund. They have provided a valuable liquidity to the capital markets and also promoting industrial development. The next one is the types of mutual funds. The mutual fund schemes can be classified into four types. The first one is on the basis of operation, close-ended mutual funds and open-ended mutual funds. On the basis of return, income fund, growth fund, and conservative funds. On the basis of investment, equity, bond, balanced fund, tax, leverage, index bond, money market instrument, and offshore mutual fund. The first one is on the basis of operation. Close-ended fund. Under this type of fund, the size of the fund and its durations are fixed in advance. Once the subscription reaches the predetermined level, the entry of investors will be closed. After the expiry of the fixed period, the entire corpus is disinvested and the proceeds are distributed to the unit holder in proportion to their holding. The major features of close-ended fund is the period and the targeted amount of the fund is fixed beforehand. Once the period is over or the targeted is reached, the subscriptions will be closed. Investors cannot purchase more units. And at the main objective is capital appreciation. The close-ended fund is purely focused on capital appreciation, not for the regular income. At the time of redemption, the entire investment is liquidated and the proceeds are liquidated. The proceeds are distributed among the unit holders. The units are listed and traded in stock exchange. These units are listed and traded, listing invested in listing securities and traded in stock exchange. Generally, the price of the units are quoted at a discount of up to 40% below their net asset value. The second one is open-ended fund. It is a just reverse of close-ended funds. Under the schemes, the size of fund or the period of fund is not fixed in advance. The investors are free to buy and sell any number of units at any point of time. The main feature is the investor are free to buy and sell units. There is no time limit. Anytime you have to buy and sell it. They are not traded in stock exchanges. Unit can be sold at any time. The main motive is income generation, that is dividend. Close-ended is focused on capital appreciation, but open-ended is focused on income generation. The price are linked to the net asset value because units are not listed on stock exchange. Close-ended form is listed on stock exchange. Open-ended schemes are not listed on stock exchange. Second one is on the basis of return. The first one is income fund. These schemes aimed at generating regular and periodical income to the member. Maybe such funds are offered in two forms. The first schemes earn a target constant income at a relatively low risk. The second scheme offers the maximum possible income. The next fund is growth fund. Growth fund offer the advantages of capital appreciation. It simply means it concentrates mainly on long run gain. It does not offer regular income. In short, the growth funds aim at capital appreciation in the long run. Hence, they have been described as nest egg, invested on long term. So the income fund is focused on regular income, and short term growth fund is focused on long term capital appreciation. And if the main features in growth fund is it meets the investors' need for capital appreciation. Funds are invested in equities. These funds are invested in equity shares with a high growth potential in order to get capital appreciation. It tried to get capital appreciation taking much risk, but this fund is also having a risk is also very high. It may declare dividend, but the main objective is capital appreciation. The next one is conservative fund. These aim at providing a reasonable rate of return, protecting the value of the investment, and getting capital appreciation, both income and capital appreciation. Income fund is focused on regular income, that is dividend. Growth fund is focused on capital appreciation. But conservative fund is consider both regular income as well as capital appreciation. So on the basis of return and income, there is three types of fund. First one is on the basis of operation, two types, close-ended, open-ended. On the basis of return, income fund, growth fund, conservative fund. And third category is on the basis of investment. The first one is equity fund. It mainly consists of equity-based investment. This type of fund is mostly invested in equity shares. It carries high degree of risk. Such funds do well in period of favorable market trend. Uh, in this type of fund, that is equity fund, the mutual fund, that is the fund manager invested in equity shares. But this type of investment equity shares, you know very well that capital market is volatile. It's not a certain, it's an uncertain thing. It's a contingency, may or may not. Sometimes market is booming. Sometimes it's down to 300 points to 400 points. For example, the past 3 months, you know very well that Nifty Sensex is also down by 600 to 700 points. More than 81,000 crores lost by small investors. Uh, any information, for example, Ukraine and Russia was the cause of problem. Yesterday, the Adani's problems, market is easily affected. So it's very, very risky capital market. So the mutual fund managers care to take care about all the situations, analyzing all the factors before going to investment. But market is very risky. So investment in equity fund. The second case is bond fund. It mainly consists of fixed income securities like investment in bonds, debentures, etc. It concentrates mostly on income rather than capital appreciation. First case, equity fund investment both in dividend and capital appreciation. The bond fund is focused on capital gain. It carries lower risk. Yes, you know very well that it's a fixed income securities, so the risk is very, very low. But in case of equity fund, the risk is very, very high. It offers secure and steady income, but there is no chance of capital appreciation. The next fund is balanced fund. First one is the mutual fund. The fund manager or trustee invested the collection of funds from equity securities. Second is investment in bonds and debentures. Third one is balanced fund. It has a mix of debt and equity in the portfolio. These fund managers invested both equities as well as bonds and debentures. It aims at distributing regular income as well as capital appreciation. Simply so by achieving the balancing the investment between high growth equity shares and also the fixed income earning securities. Next is fund of fund scheme. In this case, funds of one mutual fund are invested in unit of other mutual funds. It's not invested in shares, bonds, debentures, all these things. Investment, one mutual fund invested to another unit of other mutual funds. The next one is taxation fund. This is basically a growth oriented fund. It offers tax rebate, ATL, tax rebate to the investor. It is suitable to salary people. Next one is the leverage fund. In this case, the mutual funds are invested from the amount mobilized from small investor as well as money borrowed from capital market, collecting both short-term funds, that is small investor, as well as long investors, for leverage both these funds and invested in capital market and getting the benefit distributed in the form of NAV. Next one is index bond. These are linked to a specific index of share prices like a IT index, pharma index, or Nifty index. Investment in index bond that are fund mobilized under such schemes are invested principally in the scheme of companies whose securities are include the index content on the same proportions. And next one is money market mutual fund. These funds are basically open-ended mutual fund. They have all the features of open-ended mutual fund, but the investment is made highly liquid and safe securities like investment in commercial paper, certificate of deposit, treasury bill, etc. These are money market instruments. These fund managers invest the fund in money market instruments like commercial paper, certificate of deposit, treasury bills, investors funds. And the next one is offshore mutual fund. The source of investment for these funds from abroad, investment in outside sources like Nasdaq, Dow Jones, that funds are invested in international markets. Next, finally, one is gilt fund. This is a type of mutual fund in which the funds are invested in gilt age securities like government securities. It means funds are not invested in corporate securities. The funds are investment in government securities. So this is one of the important questions for our examination point of view. Types of mutual funds. The first one is based on operation. In based on operation, there is two schemes is there: close-ended schemes and open-ended schemes. In close-ended schemes, the size of funds and duration is fixed, but in case of open-ended schemes, it's not fixed in advance. And on the basis of income fund, growth fund, conservative funds. First one is focus on regular income. Second one is capital information. In case of conservative fund, it focuses both on regular income as well as capital appreciation. And the third category is based on investment in equity shares, that is investment in industrial securities. And the second one is investments in bonds and balanced both bonds and securities. And fund investment in fund schemes in Nifty, IT index, the tax benefit fund, leverage fund, index bonds, and investment in money market mutual funds like investment in commercial short-term securities, commercial paper, certificate of deposit, treasury bills. The fund managers invested in commercial bank, offshore mutual fund means outside industrial market, and finally investment in gilt-age securities. And mutual next question is mutual fund risk. In the following, mutual fund is having risk. That is, the risk is very low in compared to other risk. There is a majorly five kinds of risk. Is there market risk, investment risk, business risk, political risk, and scheme risk. The first one is market risk. This risk is unavoidable depending upon your macro factors. That is uncertainty about your economical situation and international factors, the Indian factor, Indian economical factors. All these factors affected the market. These arises due to fluctuation in share price, simple like a beta market factors. The second one is investment risk. Generally, mutual fund make investment on advice or from asset management companies based on the asset advice from the asset management company. If the advice goes wrong, the fund has to suffer losses. Maybe the fund managers know all the facts about the economical situation, investment analysis, all these things, but sometimes the decision is wrong. It affected your investment. So some it may advice is also sometimes wrong. It affected your investment. So that type of risk is investment risk. Business risk. Mutual fund investment mostly invested in equity shares of the company. If the business of the company suffer any loss, it affected your mutual fund. Mutual fund is also suffer. And finally, you know very well that political risk, change in government policies, bringing uncertainty in the economy, it also affected your investment channels. At the same time, it affected the mutual fund. Sometimes the scheme risk is also affected. There are certain risks in the scheme themselves. High risk or greater in certain schemes. Examples, the growth schemes. If you are investing, if you are expecting a more return from your investment, but at the same time, the market is down automatically, your income, your dividend is down, automatically affected your mutual fund. Normally, there is five kinds of risk: market risk, investment risk, business risk, political risk, and a scheme risk. Organization of the mutual fund. The structure of mutual fund operation in India There is a three tiers. First is a sponsor institutions to promote the fund. Second, a team of trustees to oversee the operation and check for efficient portfolios. Third one is the asset management companies. In India, the third category, that is asset management, actually deals with the fund. Next, investors' rights. The SEBI Mutual Fund Regulations Act 1993 contains specific provisions with regards to investor servicing. They are unit certificate, transfer of units, refund of applications monies, and auditor annual report. The first one is a unit certificate. An investor has a right to receive his unit certificate on allotment within a period of 10 weeks from the date of closure of subscription list in case of close-ended scheme, and 6 weeks from the date of closure of the initial offer in case of open-ended schemes. So this is the guidelines given by SEBI for mutual fund rights of the investor. First one is getting certificate from mutual fund is a unit certificate. Transfer of unit. An investor is entitled to get the unit certificate transferred within a period of 30 days from the date of lodgement of the certificate along with the relevant transfer forms. And third one is refund of application money. If a mutual fund is not able to collect the statutory minimum amount, it has to refund the application money as refund within a period of 6 weeks from the date of closure of subscription list. If the refund is beyond the period, each applicant is entitled to get the refund with the interest at the rate of 15% per annum for the period of the delay. And finally, audited annual report. Every mutual fund is under an obligation to its investor to publish the audited annual report and unaudited half-yearly report through prominent newspaper in respect of each of the scheme within 6 months and 3 months respectively on the date of closure of accounts. So these are the major important guidelines given by SEBI to the investors. Finally, mutual fund in India. In India, the mutual fund was UTI. It was set up in 1964 under the Act of Parliament. During the year 1987, seven mutual funds were established in public sector. After LPG, liberalization, globalization, and privatization in 1993, the government of India changed its policy to allow the entry of private corporates and foreign institutional investors into the mutual fund segment. Now, the commercial banks like SEBI, Canara Bank, Indian Bank, Bank of India, Punjab National Bank have entered into the field. LIC and GIC have also entered into the market. By the end of March 2000, there were 36 mutual funds, 9 in public sector and 27 in private sector. However, UTI dominated the mutual fund sector. In India, mutual fund is being regulated by agencies like SEBI, same thing like capital market. The mutual fund play an important role in providing savings and investment within this country. There are around 196 mutual fund schemes and the amount of assets under their management. The mutual funds are growing in India. However, the growth rate is very slow. What are the major reasons for slow growth of mutual fund in India? Means the major problem is there is no standard formula for calculating net asset value. Depending upon the mutual fund schemes and options, there is calculated. There is no standard formula. Different companies apply different formulas. There is no uniformity in the calculation of net asset value. Same things like expenses ratio. Some mutual fund schemes are getting zero point 0.5, something 0.75. So there is no standard rules for calculation of net asset value and also expenses ratios. And a mutual fund India are not providing adequate information and material to the investors. There is no good rapport between mutual fund investor. In short, there is no transparency in the dealing of mutual funds. Only the whatever information we do, all the informations are not provided by the asset management companies and also the mutual fund schemes companies. They are providing only short information to the investors. So you are providing all the information. And the mutual funds are rendering poor services to investors. Hence, the mutual fund fail to build up investors' confidence. And in India, most of the funds depend on outside agencies for collecting data and conducting research. The research is very, very poor in the area of mutual funds. In India, professional experts in security analysis are also very rare. There is a number of experts available there, but as far as our population, the professional experts and security analysis is very, very low. And the investors do not know what units are low risk for long investment schemes. Now, but nowadays there is number of app is there. Nowadays there is awareness is very, very high, but not. But we are expecting more. Now more transparency is need for this. That is a major reason for slow growth in mutual funds. So today we have to complete the two topics. One is a real estate agency. Another one is a reason for slow mutual funds. This is our fourth unit. In fourth unit, one more topic is there, venture capital. Uh, Tomorrow continue with ventures capital and the insurance, all these things. So today we have to about control it. Thank you.
Sir, one question, one thing. This PPT, could it be shared?
Yeah, no problem. I'll share it. Okay.
Yeah, maybe you can
So
provide a link.
after completing after completing your class, I will submit it. Send it to your mail ID. I will give mail ID. You send a blank mail. I will send it to me.
Sure. Okay. Thank you.
Okay.
Good morning, all of you.
Good morning.
Good morning, ma'am.
Hello, good morning, all of you.
Yeah, good morning, ma'am.
Yeah. Hello. Can you see PPT? Yeah.
Yes.
Last class, what we have learned: ratio analysis, fund flow statement, cash flow statement. So all the problems oriented chapters we have studied, right? So now some management concepts are there, some other strategic method of costing system. So let us see. These are all theoretical part, not in the problems. So fifth unit is also management reporting is theoretical part. Some other management systems, strategic planning is there. So let us see one by one, right? um, next one, value chain analysis. What is value chain analysis? Value chain analysis is a strategic framework that helps companies understand how their activities create value for customers and they have to improve that activities. That is value chain analysis. There are various activities are there in that process, from the production to till the after sales, service given to the after sales to the customer, like that. So you have to make the activities in various process, various stages. You have to identify the value activities and where you can improve that activity, improve that value added in that activity. That is called value chain analysis. You have to create value to your customer, and at the same time you have to create increase the value for the company, that is profit, maximizing profit to the shareholder, like that, right? So in this case, how to identify what is the activities in that processing, right? So what are all the activities are there, how to identify the activities and how to improve, how to give value system in that particular activity, how to improve it. So this is called value chain analysis. This value chain analysis we used to take it as a strategic planning. So some strategy you have to adopt. It is treated as a strategy for adopting to increase the profit margin. How to increase the profit margin? When you say, for an example, if you are giving guarantee 5 years, if you are purchasing television, if you are giving 5 years or 3 years warranty, and then after sales services, if any problem comes, the services will be provided and the customers will be happy, right? So which brand or which product gives you more value for your product? So definitely these customers will value your product, right? So automatically the profit will increase, right? So this kind of the analysis of this value analysis identify where the value of specific production and sales activities can be increased. You have to identify what are all the processes are there where you can add value of your product, right? So you have to discover the opportunities for cost reduction and improve the customer value and businesses and can decrease the production cost. So once it is the increase the another one way, it has to increase the value of the customer, and at the same time you have to decrease the production cost, right? And increase the revenue. So it is a path. Value chain strategy gives you a strong path for outperforming the competition and becoming the leading company in your particular field. And sales matrix and analysis include trouble spots in your sales process, right? So it indicates these trouble spots in your production process. So I already explained you this value chain analysis. What is value chain analysis? It is the each of the activities you have to evaluate and where you can improve. Where you have to identify the activity and you have to give the opportunity for improvement of that activity, right? So it gives the cost reduction and product differentiation from other branded, and then you can increase the performance of one on performance of both the primary activity and then secondary activities, right? See here, what are the purposes of value chain analysis benefits? So one and the same thing, that is reduce the cost, optimizing the profit, increasing the optimizing the inventory, better vendor management, and improve the customer relationship, and then standardizing and optimizing the processes helps you gain a competitive edge. So all these things are the benefits under value chain analysis, right? See here, components. What are all the components of the value chain? See here, Porter given definition to make up the firm's value chain analysis, split into two category: primary activity and then supporting activity. See here, what are all the primary activity, what are all the secondary activity. Value chain processes are there: infrastructure, human resource management, technological management. These three heads, these three activities comes under the support activities, not a primary. Support activity. Primary activities are procurement. When you are procuring the raw material and then components, equipment, services. So procurement also you have to adapt strategic planning. And then logistics is very very important thing. Inbound logistics. Inbound, what is inbound logistics? That is when you are say for an example, hammam production company is in somewhere, right? Some head office will be there, they manufacture in one place. But where you are buying, when it is go for sales to all over India, the price will be the same. If you are purchasing in Chennai, the same price. If you are purchasing in very remote area of village, you will purchase the same price. How it is possible? Because of the inbound logistics. So inbound because transportation is very very important factor for cost will be added with the manufacturing of that product, right? So when it goes for say for an example, head office is in Bombay, right? So how they are distributing, how they are channeling, that is logistics and supply chain management. Due to that, wherever it is going for supplying the material, the cost price of the product will be the same, right? So that is called inbound logistics. Then operations. So what?
Madam,
Yes.
yeah, regarding the procurement, you said it's a primary activity, but in the diagram, it's in the secondary activity. So
No,
does
no.
it mean?
See here, secondary activities are these three things: infrastructure, human resource management, technological development, these things, right? So comes under the primary activity. See here.
No, no. So that's so
Yes,
then
yes, yes.
diagram, it seems
Yeah,
the
yeah, yeah,
second.
yeah. It's correct, correct, correct. Procurement is also comes under secondary activities. Primary activities, they are saying that inbound logistics, operations, that is when you are raw materials comes to work in process comes to finished product. There are various value adding techniques, strategies are there, right? And then outbound logistics, when you are selling for international market. So, when you are exporting to some other country, so their cost of transportation will be different, right? So you cannot sell hammam, say for an example, 50 rupees selling price in India. The same price we cannot give it in USA, right? It will be different, right? So that is outbound logistics, right? Then marketing and sales. So marketing, there are various promotional activities will be undertaken, salesmanship, advertisement, then pricing strategy. So many strategies will be adopted under the process of marketing and sales. Then after sales services, there are installation, and then after sales service will be provided. If any problem comes, the service persons will go and attend the customers, like that, right? So then guarantee period. So all these things are very important aspects. So these primary activities or support are very where you have to identify which process where you can add the value. Where is, say for an example, if you are increasing your guarantee period 3 years to 5 years, and then you can increase your service, that is if any small problems comes, they can you can give a replacement for particular period. So many things are there that the customers will value that product, right? So the same thing I have given here: primary activities, secondary activities, or supporting activity. Inbound logistics, operations, outbound logistics, marketing and sales services, right? Then secondary activities, that is infrastructure, technology development, human resource management, and then procurement. So even if it is a procurement, if you have taken purchases of raw material is very very important aspect. You can you have to buy raw material in a quality one, and then price, how to adapt a strategy for when you are issuing for production. There are various methods, FIFO method, LIFO method, so many methods are there in storekeeping. So you have to adopt the some strategy for reducing the cost of production, but at the same time you have to increase the value of your product, right? That's all with regards to say value of chain analysis. Next one, ABC costing. ABC costing, it is a activity based costing. Activity based costing, which means the cost in traditional method, what we do, cost is allocated based upon machine hour or labor hour or material based. So many methods of allocation of cost. You have to determine the price of the product. When you are determining the price of the product, cost will be allotted based upon resources, or we can say, we can take it as how labor hour, how many labor hours you are involving in the production, based upon number of units you are producing, right? That is the usual practice. But under activity based costing, the costs are allocated based upon activity. So activity means what? You have to allocate the resources based upon how many. Say for an example, if you are producing car company, right? So if you are producing the when you are making wheel, how many times you are using that machine, or how many hours, so that you have to identify the drivers. So when you are allotting resources to that particular processes, how many times you are using, based upon the drivers you are allocating resources, and then you have to determine the cost based upon this activity. That is called activity based costing. So this activity based costing is an approach of optimizing cost and time. So you have the main factor in this, you have to optimize the cost and time. Activity based costing, that is resources are assigned to activities. Resources means what are the material, labor, whatever resources you are allotting, or machine hour, labor hour, based upon the activities which are consuming your resources, right? So see here, you have to identify the two thing is that ABC costing is the relationship between activities and cost drivers. See here, resources are allotted based upon the activities. So what are the activities you are underlying in that, how many times you are utilizing, or how many hours you are utilizing, you have to allocate the cost based upon that, right? So what is the necessity of activity based costing? Necessity is it is the very, in a manufacturing industry, big manufacturing industry, there will be a shift basis. 24 hours it may be running, the labors will be switch over, right? So how to identify their you have to evaluate their performances, right? So how to evaluate, how to determine the processes of cost. So the technological innovation and then automation of the any advancements, then it is to be given importance for activity, right? And then labor based manufacturing of the product, there are various factors which are there, that is depreciation, maintenance, repairs. So overhead cost, how to allocate based upon the this cost drivers, right? So like that, it is very important, right? And then no correlation between direct labor and overhead costs. So generally in traditional method, overhead cost will be allocated based upon direct labor, that is how many hours the way workers are working, based upon it will be allocated, right? But here you have to allocate based upon the activities. So this activity based costing where we can apply. So this can be applied in particular value stream, and decision making where you are taking decision making for determining the profitability of the product or services. And then you have to activity based costing, it provides comparative standards to perform benchmarking and re-engineering. So it gives you benchmarking, so where it gives how number more times, more activities, more resources you are allocating, so you can get the important activities, right? See here, processes of activity based costing. First you have to identify the major activities, what are all the activities are undergoing in the production of particular product, right? So in large organization, it is several activities will be there. Say for an example, if you are manufacturing cloth, what are all the processes are there? First spinning, you have to take cotton into that yarn, right? So that spinning, weaving, and then dyeing, printing, and then designing, and then garments, right? There are various processes are there. So when you are getting the final product, so you have to allocate the resources based upon these various processes, right? So you have to identify the various processes or various activities which are involving to produce the product, right? Then you have to identify what are all the costs associated with that activities. So what all the cost will be associated, what is the finish one process, finished product will be the input of another process, right? So what is the cost involved in that, and what is the labor will be involved, what is the overhead cost, indirect labor cost is involved in that particular activity, that you have to identify. And then you have to identify factors affecting those costs. Factors affecting, what are all the factors which are affecting those costs, called cost drivers, and calculate the cost drivers rate. So cost driver means that activity how many times, so you have to calculate how many times it has calculated, right? So you have to find out and identify the activity and then cost driver. So based upon the cost driver rate, allocate the activity, and cost is to be determined based upon the product cost, right? So when you are identifying the activities, it is involved the various things, that is unit level or primary activities, batch level activity, product level activities, then facility level activities. So when you are assigning cost to activity cost pools, that is cost pooling, total cost incurred for that particular activity. For small things, you can take into one, you can merge into one, that is called cost pooling for a particular period of time. Then identify factors influencing the cost of activities, and then assign the cost of activities to the product. So product, you have to identify the activity and what is the overhead cost come into that picture, right? So what are all the benefits of activity based costing? So what are all the benefits? It provides accurate information and gives you the correct cost structure, right? So it enhances the controlling of cost, overhead cost, you can control it by, because of you can identify where it is more cost is spending, why it has happened, you can raise the question, and then you can avoid. Say for an example, raw material when you are using for production, wastages will be more, right? So which activity gives you more wastages, so you can control that cost. And then managers can make better decision taking is very effective in the system. Limitations means that is for identifying activity and cost driver, if it goes wrong, if anywhere it is wrong, so automatically total time and effort will goes waste, right? So it is complexity, easily we cannot understand. Those who are involving in that manufacturing processes, they only can know what are all the activities are involved. So it is a complexity one. And then a more it is when you are establishing this ABC costing, the expensive, it is not like tradition, it is just like that. What is incurred, overhead is allotted based upon the number of units produced. So based upon that we are allotting, right? That is no expensive, nothing. So when you are going for this, each and everything you have to evaluate, you have to do, for that you have to appoint some persons, supervisor, then allocation of resources, you have to appoint some persons. For that you have to pay for their salary. So many things are there, right? So it is expensive. The next one, quality costing. What is quality costing? Quality costing, which means total expenses incurred by organization by maintaining good quality. So what are all the expenses which are incurred for producing the product? The product should be in a good quality, and you have to managing the poor quality of the product, get into that line to attain the highest level of customer satisfaction. Suppose if any default comes, you have to rectify it, you have to increase the customer's satisfaction. So quality costing is very very important aspect and effective management tool for collecting and measuring expenses in maintaining quality in a production process, and also identify the non value added expenditure, right? The next one is cost of quality, components of cost of quality. So what are all the components are there? There are two categories. One is cost of conformance or cost of good quality. Another one is cost of poor quality or cost of non conformance. What is good quality? Cost of good quality, it includes cost of assurance and then cost of prevention, right? Cost of assurance gives you the procedures and then control measures and then quality of standards and establishing various procedures and capability of studies. Then you have to design the product. So all these things will be incurred in that cost of assurance. And then cost of prevention. So if any damages occurs or any problems arise in the process, you have to prevent for that specifications, right? Then poor quality, so cost of appraisal and cost of failure. So that is cost of failure and appraisal will be involved in that processes, right? Then target costing. Target costing, it is a management technique or tool which is decided for when you are fixing the prices of the particular market condition. Say for an example, competitor. If you are producing, say for an example, um, soap you take, right? So same type of quality and quantity, same type of quality, size, flavor, various competitors are available in the market, so you have to compete with them. So 50 rupees normally if they are charging, you cannot go beyond 100 rupees. So in that case you have to target, fix the target of that costing within 50 rupees, 5 rupees, 10 rupees here and there, no problem. But if it is beyond such level, the customers will not like, right? So you have to give a product at the quality one, and at the same time you have to compete with the competitor, right? So it includes cost planning in the initial designing and cost control in throughout its life cycle of the product. So life cycle of the product, what is the life cycle? When you are introducing, at the introduction stage, initial stage, and then growth stage, then it decline stage, again you have to bring it to the booming stage, right? So various stages of product life cycle you have to try to give the more competitive market price, right? What are the features of target pricing? So the company is a price taker rather than price maker. So price, what is price taker? What is price maker? Price taker means at the available market condition, how the competitor selling, determining their selling prices. it should be average. That is 50 rupees means 52 rupees or 55 rupees or 45 rupees. Here and there you can fix. That is price taking. Not what is price making means what? Your product, what is the cost? When you are determining or assigning your cost of production incurred, say for an example, 80 rupees cost of production is incurred for that particular product. So 10 rupees you are making, adding as profit. So 90 rupees you are determining selling price of that particular product, right? So the same type of quality and same type of these various competitors, they are ready to give up, give it to the market 50 rupees, 60 rupees, like that. So customers will not buy your product 50 rupees, 60 rupees. It is available many type of brands, many type of thing. How, why they will go for 90 rupees? What is the speciality in that? If it is, if you are giving the premium price, there should be some specification, there should be some speciality should be there. Otherwise you cannot sell your product in the market, right? So it is very very, that is why this target costing gives you the price taker, not, you cannot making the price. So when it is a monopoly, there is no competition. In that case you can make the price, whatever fixing price by you, that is the final one, right? So everybody should buy in that price only. But when you are in perfect market condition, there will be a more competitor. So you have to see the competitor prices of that product, right? The next one, life cycle costing. What is life cycle costing? Life cycle costing, which means total cost throughout the life of the product, which includes planning, designing, acquisition, support cost, and other directly attributable to the asset. So not only the product costing from the beginning to end, what are all the process you are undertaking, life cycle cost, which represents the total cost of ownership. So at the initial stage you have to spend more for infrastructure, research and development. So all these things will also to be included in that, right? So included in the, when you are determining the product cost, right? The next one, theory of constraints. What is theory of constraints? Constraints mean once system contains a choke point that prevents it from achieving its goal. So constraint means where it is a default, where you have to see where any problem arises. So where the bottleneck, where that constraint comes. So that you have to identify, and then you have to make it feasible, and you have to rectify that in operational activity. You have to bring it to the normalizing that capacity of your product. So when you are generating the capacity of the constraint, say for an example, your company, you are producing at 70 percentage of level of capacity, cost per unit may be total, that is cost per unit when you are determining 100 rupees, right? So when you are utilizing 100% level of capacity, you know very well the expenditures we are dividing into fixed expenditure and variable expenditure. When you are increasing your level of activity or level of production, automatically only the variable cost will be involved for manufacturing of particular product. So when you are producing at 70% level of capacity, its cost comes 100 rupees, right? When you are utilizing 100% level of capacity, you can reduce your cost price. So cost price, when you are reducing it from 100 to 80 rupees, automatically you will also get revenue profit, and at the same time when it goes for customers, the prices will also be less. So the constraint is, if you are identifying constraint in the level of production, you have to rectify it. That is the concept of theory of constraints. Okay. Example is also given here, you can go through later on. The next one, Unit 5, this is fourth unit. Totally some management cost concepts have given, that is value chain analysis, ABC costing, theory of constraints, and then life cycle costing, target costing, then quality costing. So these are all the some concepts, management concepts of latest concepts, right? The next one, fifth unit, there are some concepts are there, only theory part. Reporting to management is the main aspect in this unit. And then social cost benefit analysis. So social cost benefit analysis, what is the social cost benefit, then decision tree in management, then reporting to the management. Only this reporting to the management is very very important theoretical part in your management accounting, right? First, let us see social cost benefit analysis. What is social cost benefit analysis? It is called as economic analysis. So, decision making strategy. It is, we can say it is a decision making strategy which helps the assessing impact of investment business projects on the society as a complete. So nowadays, you know very well, each and every companies, they have to undertake some social activities. Say for an example, in India, they have to adopt some villages. They have to develop some infrastructural facilities in that particular village, and then education given for that villages, and then they can make other facilities, say for an example, water, irrigation, and then power. So all these things, so that is that comes under social cost benefit activity, right? So when you are making that investment impact of your project, that investment that should help both organization and actual as to the society, right? So it is an organized and cohesive mechanism to contemplate the impact of development projects of the society. So development projects, that is infrastructural development, and then development of the villages, and then transportation facilities you are improving. So these are all the things, right? The objective of analyzing the social cost benefit, it is the weight to heterogeneous impact of your development project. So what is heterogeneous means specific impact impact that should develop the society. And then you have to see the elements of, say for an example, uh, if it is a dyeing factory, if you see that Salem, the road, the Tirupur, that side many dyeing factories are there. That wastages they are giving brought into that river, Kaveri river. So it is very injurious to the health of when, those who are using that Kaveri river water. So it is spoiling. So for that they have to develop some particular plant. They have to install a big plant that installation of plant becomes multi crores. Small business peoples, they cannot afford it. So those, it should be utilized for near. It should be cleaned, that dying waste waters and all, right? So it should be helpful from helpful to the society as well as to the companies, and then small business plan those who are holding in that area. So these kind of, then it gives the good health improvement, and then environment, and then so many things, right? So like that, if some chemical factory or chemical industry is there in that, total agricultural land will spoil. That underground water, if they are if they are, the wastages goes into that land, so many problems will be arised. And then now you know very well that Tuticorin, that is Thuthukudi, are in and around that chemical factory. Why they are making? Because of pollution, and that makes the injuries to the health of the people surrounding that people. So it should be very carefully. They have to take welfare activities, and then they have to adopt all these things, right? So it gives the positive impact, that is called social benefit. social benefit instead of negative impact for that social cost. When you are investing cost for the society, for any infrastructural, and then for prevention of the wastages, pollution. So all these things are very positive aspect, right? Positive impact. Then decision tree in management. So in management, what we can say, what are the decisions you have to take in various, not only one decision, various, each and every stages, each and every activities decision which should be taken, right? So when your decision, you can there are two methods are there: centralization method and then decentralization method. So generally, decentralization method is very effective than the centralization. When you are mm, responsibility, when you are assigning the responsibility, automatically the authority and responsibility will be automatically created, accountability will be created. So when the decentralization gives the power, delegating the power to the supervisory level, they can take decision making regarding that particular unit. So no need to take into the centralization. So this kind of various decisions will be taken at the various levels. That is called a decision tree, right? So this graphical representation of possible solutions will be given for the decision based upon certain conditions. So if this is the condition, you have to take this kind of decision like that. So that is the possible solutions you have to take up, right? Decision tree, that is why we can call it as a decision tree. Start with a single box, that is at a router level, and there will be a more many number of branches like that. Various solutions you can give. Only one problem, for one problem you can give many solutions, and various stages problems arises, that gives the management to help the taking decision making in a systematic manner, and then documented wherever the solutions have taken, they have to see the activities, right? So the biggest limitation of our decision making tree, uh, you have to see the alternatives. If you have to take plan A or plan B. Plan A, if it fails, you have to go for plan B, like that. So you have to set the alternatives for the problems, right? Then reporting to management. Reporting to management is a very important aspect, and then it gives the information, it provides the information to the various levels of management. So organization structure, various level of management, that is from the top level to bottom level. Top level, that is executive management, and then board of directors, CEO. Under that board of directors, under the board of directors, there are some various managers, that is MD level. Then next, you have to go for activities based managers, that is production manager, sales manager, and marketing manager, finance manager, like that. So various activities manager, under that some supervisory cadre, some unit wise, area wise, like that. So the organization structure gives you the various responsibilities to the various levels, right? So respond that we are already studied responsibility centers. Responsibility centers, that is cost center, investment center, and then profit center, right? So when you are delegating the authority, and your organizational structure is well established, and when you are delegating the authority, automatically the accountability and responsibility will be taken, automatically created, and it gives the corrective measures, right? So the, you see, for an example, at the lowest level, those who are under the foreman level, they report to their supervisor. Supervisor will report to their section or their area manager. That area manager will give the information to the production manager, and then production manage the coordination between the all the managers, that is activity manager, production manager, sales manager, finance manager. So all this they have to coordinate all these informations. They have to pass on to their higher level board of directors level. Then board of directors level they have to take decision making, and then CEO, MD, and then for CFO. So many cadres are there, right? So it is the reporting from top to bottom, bottom to top, and then the powers and information solutions decision from top to bottom level, right? So this management reports aiming to informing or information provided to the managers of different aspects and different level for taking better management decisions. So, what are the objectives of reporting to management? So, what are all the objectives are there? That is good means of communication. When it is reported from one to another person, the communication, effective communication is very, very important aspect. Suppose if misinterruption or misconception of reporting it goes to the another person, it will be a the solution will not be what we can say, we cannot achieve that aspect, right? So satisfy the interested parties. So you have to satisfy each and every aspects to the concerned persons. So that is say for an example, motivation will be provided to the worker for improvement of or increasing their level of production. So there are two types of motivation is there: positive motivation, rewarding, giving a bonus or like that. There, and also there will be a negative motivation is also there, that punishment and other thing. So the positive motivation will generally increase the productivity of the workers, right? So you have to, it is to be very helpful for increasing your production. So it should be satisfied by not only at the lower level, foreman level, and at the same time it should go for supervisor, and then go for all the top level management. If particular production unit, if they are showing achieving, you have to fix the target. When they are above the comes to their production activity will go for above the production level, automatically the reward will be given to that head particular production manager, and it should carry forward to the various levels of supervisors, and then it goes to finally workman also, right? So this satisfactory is very, very important objective of this reporting to the management. Then serve as a record. This management system, when you are making it, it is a creating record. Why? Because you have to prepare this cost sheet, cash flow statement, fund flow statement, and then when you are calculating ratios for taking various decision making, so you are creating a record, and then it serves the various levels of management at for taking decision making. Then legal requirements. So you have to management accounting is not a compulsory one, but at the same time financial accounting will prepare only trading profit and loss account and balance sheet. That is the final statements. That is financial accounting. In management accounting, we are preparing fund flow statement, cash flow statements. That is also in annual report. It will be published, right? So that gives the that gives serves as a good record to the public. What is the inflow of the inflow and outflow of cash, what is the working capital of the working capital conditions of the company. So many things they can comes to know, right? Then develop the public relations. So develop the every each and every companies, they have to develop the public relations activities very smoothly. Why? Because when they are going for social cost benefit activities, that is social responsibility, we used to say it is a social responsibility of the gives the impact good public relations, right? Then basis to measure performances is definitely when you are adopting various strategies and techniques. Say for an example, if you are going for a variance analysis, standard costing that gives the performances whether it is favorable or unfavorable condition. And then if you go for ABC costing, that gives you the performances measure for each activity under each unit, that you can evaluate their performances. Based upon that, you can give reward to that particular activities, right? So it gives the better performances. Then control. So management accounting gives you, it is using as a tool of control. If you are preparing standard costing, then you can find out where the expenditure incurred more. So when you are adopting various strategy, they automatically not only for expenditure, but also there will be a control mechanism will be established for each and every aspect, right? So there are three types of management levels are there. That is already told. Top level management. Top level management comes under board of directors, CEOs, managing directors, executives. These are all the top level management. Middle level management, that is functional activities. Managers of the various functional activity. They say for an example, production manager, sales manager, marketing manager. So these are all secondary, middle level management. Then lower level management comes under supervisor, then foremans, and then uh, those who are watching that particular unit, general manager, like that. So these are all lowering and operating level management. Then what are the types of reports are prepared in the management system? So there are various types of reports are prepared. That is external report, internal report, routine report, special report, operating report, control reports, information report, then financial report, predictive reports. These are all the various types of reports are prepared. From time to time it will vary, depends upon the demands of the managers. It will be prepared. Finance section will give the financial report at the end of the year, or 3 months once they can prepare what is the budget. All these things, not only that one. Then external reports, it includes preparation of fund flow, cash flow, or this ratio analysis. These are all external report. The internal reports are that is supervisors preparing report to that production activity to their top level management. So that is internal reports. So routine report, that is every monthly once, routinely they used to prepare and they have to report to their top level management. That is routine report. Special report, suppose any auditing is going to conduct. So in that case, a particular activity is going on. So that specific report may be prepared, right? Then operating report, various operating activities, they have to operational uh, section, they have to prepare reports. Then control reports, standard costing, ABC costing, these are all the systems they have to prepare controlling reports. Information reports, that is what is the actual production for this month, what is the actual sales. Every functional manager should give the report to their top level management. Then financial report, financial department, finance department, auditor, accountant, they have to report monthly once or weekly once or 3 months once or yearly once. So all these things they have to give in their report. Predictive report, sometimes predictive report that means what. If they are preparing budget, that is the predictive one. So you have to prepare planning for that particular period. So that is the predictive report. So what are the methods of reporting? So what are the methods or modes? What are the modes are there? Generally, some type of things are oral report is also there. Some most of the reporting covers the written statement in the form of statement. Say for an example, preparation of financial statements, preparation of statistical tablet. Say for an example, various segments might be there, various processes are there. So what is the production for this month? What is the opening stock? What is the purchases, procurement of raw materials? So what is the stock? Is there stock report? They have to every weekly once, depends upon the organization size. Weekly ones or monthly ones, they have to report the stock. Based upon that, it will go to the purchases manager. They have to prepare. So these are all the statement type of reports they have to prepare. Then geographical report. Geographical report, that is graphic. Sorry, not geographical. Graphic report. So what is the previous month production, current month production next? That graphic representation type of report may be also prepared. Then oral report from then and there, various stages of level of management whenever requires oral reporting is also going to happen, right? So these are the modes of reporting, various levels of types of reporting, and then various levels of management. What are all the things? Reporting to the management is very very important aspect for when you are establishing the system of your management system in the organization. So your management system, when you are establishing in the company, you have to see the size of the organization by various factors which are determining the what kind of system you are going to adapt. So it depends upon the size of the company, nature of the company, and then type of the product, nature of the product, and then what is the level of capacity, and then what is the market availability of the market, competition. So many factors, and then goodwill of that company, and then so many factors which will, and then natural calamities. If any natural calamities comes, if it is affecting the production function, so you have to see various aspects, right? So various decision makings will be taken under various situations, and then you have to see economic factor. Economic factor is very very important aspect. In under that you can see interest rate, inflation rate, and then foreign exchange rate, and then purchasing power capacity. So many factors that will determine and that will affect the company under various circumstances. Various decisions making have to be taken, right? That's all with regards to this management accounting. Say this is your syllabus. Wait. Say this. Have you read your syllabus? This is your syllabus. It covers 60 percentage is problem, 40 percentage is theory questions, right? So for 60 percentage problems covered under that, they may ask you problems, that is preparation of budget, flexible budget, cash budget, and then marginal costing under that, CVP analysis, that is break even point, various decision making problems. These are the questions, problem questions, and then fund flow analysis, cash flow analysis, and then ratio problems, ratio analysis problems. These are all the problems oriented. 60 percentage may be covered. part A, part B, and part C, right? So part A consists of 10 questions. Out of 5 questions, you have to answer 4 marks, right? 4 into 5, 20 marks. Then part B, 8 marks question, 10 questions will be given. Sorry, 8 questions will be given. Out of that, you have to write 4 questions. Part A also 8 questions will be given. You have to write 5 questions, right? So 8 marks into 5, 40 marks. Then case study is 15 marks. Then 25 marks is internal. So internal, that is objective type, we will conduct later on. First you have to prepare for the external examination. While studying for external examination, you have to each and everything go through for objective type also. Say for an example, mm, what is the controlling technique of management accounting? A, B, C, D will be given. So you have to choose the answer like that. And then two assignments will be given for you. Two examinations. Then they will make it as average, right? So that we will intimate later on. For external examination point, you have to go through the theory questions also. Theory questions, most probably they may ask first chapter, that is what is general responsibility centers, and then transfer pricing, what is transfer pricing, what is its modes, and then what is budgeting also they can ask theory question, and then what is master budget, and then what is break even point, what are all the decision making they may take, then what are the limitations and advantages of ratio analysis, and then what is target costing, what is activity based costing is important aspect for examination point of view, and then what is target costing, what is life cycle costing, and then what is the social cost benefit analysis, and then reporting to the management, like that. So theory part they may ask from this one 40 marks, 40 percentage. So you should be very carefully go through all these things, and then problems and all you have to practice it. Then standard costing, if you have to practice all these things in the first semester, you have studied only material cost variance and labor cost variance. Here you have to study overhead cost variance as well as sales variances also you have to go through, right? So very carefully you have to study all these things. Okay. Our 6 hours are allotted for per paper. Today is the final class is over. If you have any doubt, you can ask me right now. 5 minutes I will give you. Whatever doubts you can ask me. Any doubts? Anybody in management accounting? And then one more thing I want to tell you, you have to write all answer for all the questions, attend all the questions. That may not all the questions, that means what? Part A, 5 questions compulsorily you have to attend. Part B, 5 questions compulsorily you have to attend. Whether you know or not, you just attend. Whatever the related things you have to write it. Part C, case study, say they may ask you in general, sometimes they may ask problems, prepare fund flow, prepare cash flow, or marginal costing technique, they may adopt some strategy or some planning, many things they may ask. Sometimes general questions they may ask, that also you don't leave it, even though if you do not know, whatever you know related to that you attend, don't leave it. Sometimes somebody they are attending 2 questions, only 2 questions from part A, 3 questions from part B. So how can you make pass? You are going to write only 75 mark. Out of 75, you have to attend all the questions. Then only you can secure at least 40 marks. Right? Any doubts?
Please share all the PPT, ma'am.
Okay, no doubts. Can we wind up the class? All the best. Prepare well for the examination.
Ma'am, please share all the
Ma,
PPT, ma'am.
send mail. Mail to that my mail ID.
Okay.
My mail ID is
Okay, ma'am.
see.
Yeah, you shared me last time,
Yes, you sent
but
mail.
you didn't
To those who
download.
have sent mail, I have sent. I have shared. You
Okay,
send
okay.
mail, then only
I will see.
I will share you. Okay.
Okay, okay.
This is
Thank you,
my
ma'am.
mail ID. Okay, all the best.
Good afternoon. Good afternoon.
Good afternoon, sir.
Very good afternoon. Shall we start now?
Yes, sir.
So now that we are moving on to unit number 3, this is about project evaluation, wherein we have a structure like this. Tradition and sophisticated techniques used for evaluating the projects under the conditions of certainty, then under the conditions of uncertainty, and then social cost benefit analysis. These are the 3 major areas to be covered under this unit. So we must know what is the meaning of project evaluation first. Is it visible on the screen? Project evaluation. Is it visible?
Yes, sir, it's visible.
Okay. Okay. If it is not visible, you tell me. Otherwise, I will continue this. So the main purpose or idea of project evaluation, otherwise known as investment appraisal procedure. This project evaluation is also known as investment appraisal procedure. The very purpose of this is the comparison of uncertain future cash inflows with that of uncertain cash outflows. What is the meaning of this? Let me give an example. So whenever a company goes for investment in some capital expenditure proposals. So here we must know what is the meaning of capital expenditure proposal. See, in business, you know very well that the expenditure may be broadly classified into 2 categories. One is revenue expenditure, other one is capital expenditure. Any expenditure incurred for the purchase of fixed assets like land, building, plant, machinery, etc. is a capital expenditure. On the other hand, any expenditure incurred for the acquisition of some special rights to the business like trademark, patent, goodwill, royalty, something like that. That is also treated as capital expenditure. So whenever a company wants to invest its money in capital expenditure like establishment of plant and machinery or construction of factory building, something like that, it has to decide whether to go for it. If at all we have decided in favor of investment, in which avenue it should be invested, all these things are to be very carefully taken care of. Therefore, the amount we invest in this capital expenditure project is known as outflows, cash outflows. The amount of money invested is called cash outflow. So whenever you invest some money, you expect some sort of return out of that. Suppose that a company wants to make an investment of 10 lakhs rupees in a project. Say some project, in a project, it wants to invest 10 lakhs rupees. And it expects to yield an annual turnover or income or profit, otherwise, annual profit of 2 lakhs rupees. The amount of money 10 lakhs rupees invested is called cash outflow. Then the amount of profit that is expected to be earned over the period of 5 years is known as cash outflows. So we have not made any investment now, we are planning to make an investment. Therefore, what happens? Both cash outflows and cash inflows are to be made in future. So in that case, you know very well the nature of future is highly uncertain. What we expect as inflow may or may not turn up in future. Under the conditions of this uncertainty, how we are going to make a decision, about which only this project evaluation deals with. The practice has been generally accepted that whole procedure of evaluating the profitability of an investment is based on the future value, the present value of future money. The whole decision making criteria under capital expenditure proposal evaluation depends on the concept called present value of future inflow, future money. Say, I said that we expect to earn 2 lakhs rupees every year for a period of say 5 years or 7 years, something like that. So what we expect is in future. Had it been received now itself, what is its value? That is called present value. So present value of future cash flows will be determined. Based on that only, decision will be taken. So on this basis, the various methods that have been devised for this purpose are broadly classified into two categories. They are called traditional techniques and discounted cash flow techniques. Traditional techniques and discounted cash flow techniques. So under traditional techniques again, we have say 3 methods: urgency method, payback period method, accounting rate of return method. These are the 3 methods widely used under traditional methods. Then we have discounted cash flow techniques, otherwise called sophisticated techniques. Under that we have 3 methods: the net present value method, present value index method, otherwise known as benefits cost ratio method, otherwise known as profitability index method. Then the third method is internal rate of return method. So these are the various methods that have been generally used for deciding whether to go for an investment in a project or not. I think you have got the point now. Now the problem is we have to discuss about all these methods one by one. Then, as far as your syllabus is concerned, that is very clearly given in the syllabus that in out of these methods, in only 2 methods you will be asked problems. You may be asked problems. That is, problem-oriented question will be there. That is net present value method and internal rate of return method. That is very clearly given in your syllabus. Anyhow, for an understanding, let me explain all these methods one by one. Right? The first method is urgency method. What we mean by urgency method, when it is to be followed. Urgency method. This method is useful whenever we have to solve some immediate problem, particularly under the situations where time is a constraint, or external factors require immediate action. These are situations under which urgency method can be used. Say, whenever a decision is to be taken regarding capital investment proposal, many factors are to be considered. Say, for example, the amount of money required, where from we can get this money, under what terms and conditions. Terms and condition means the amount of repayment, number of installments to be repaid, rate of interest, all these things are called terms and conditions. Then the profitability or otherwise of the investment, whether we can make expected profitability or expected return on investment may be obtained or not. Like that, many factors are to be considered. But under urgency method, only one factor will be taken into account, that is called need of the hour. No other factors like amount of money, where from you get, what is the rate of interest, what is your installment, nothing will be taken into consideration. Only the need of the hour. If the situation is emergency, then immediately you have to take a decision. That situation, that method is called urgency method. So whenever the situation is like that, immediately you have to take an action. We cannot postpone it, we cannot drag it, immediately it should be taken. Means urgency method will be taken into consideration. In that case, no quantitative values or variables will be taken into account. What is quantitative variable? Amount of loan, amount of money required, or rate of interest, amount of number of installments, amount of EMI. Nothing will be considered. Only qualitative factor, that is urgency of the situation, emergency of the situation. Let me give an example so that you can understand the situation. Suppose that your company presently undergoing a huge order. For that, it is the process of manufacturing commodities going on. Suppose that the order is to be delivered, executed rather, say on Tuesday. Coming Tuesday, the order is to be executed. It is a very big order. The order is from foreign country, and it involves in the matter of foreign exchange. All these things are there. Many issues are there, and when you execute this order, you will be expecting to get huge amount of profits. If you fail to execute, you have to face the situation. That is, you have to face the consequences. If the foreign order is not executed in time, then you have to pay heavy amount of compensation. That is the nature of contract under which you are now proceeding with the manufacturing process. Now that almost 90 to 95% of the production is over, another 5% is to be done. Suddenly, what happens this night? That is today, Saturday, Tuesday, it should be dispatched. This night, what happens? One important machine got breakdown. One important machine got breakdown. Then immediately we summoned the technicians. The technicians, after careful analysis, came to a conclusion that this machine is beyond repairs. It cannot be repaired now. Rather, it should be replaced. That's all. That is the decision given by the technician. Now, to replace that, I said there are many methods. Say payback period method, accounting rate of return, net present value, this and that. Many methods are there. And immediately, what happens? We have to call the meeting of all the experts, governing body, something like that. We have to discuss the matter and then find out the source of finance. All these things are there. Usual procedure. But under this situation, if you do all these things, your execution of the order will definitely be delayed. Then you have to pay huge amount of compensation. In that case, you ignore all these factors and take a decision immediately to replace it by a new machine. That's all. Other things will be not taken care of. Because if you fail to do so, you have to pay huge amount of compensation to the foreign company. To avoid that, setting aside all the other factors, based on the emergency of the situation, need of the hour, We have taken a decision to purchase a particular machine immediately. This is called urgency method. So here no quantitative variable will be taken into consideration. See, next traditional method is payback period method. Payback period method. The very name suggests the meaning of it. Payback. That means the period within which the amount of investment made is returned back, paid back by the project in the form of returns, in the form of profits, or in the form of incomes. Such period is known as payback period. I repeat, the period within which the amount of investment made in a project is paid back to the company in the form of income is called payback period. Say, for example, uh, suppose that we are making an investment of 10 lakhs rupees in a project. I hope you are listening. You have to tell the answer now. You suppose that you are making an investment of 10 lakhs rupees in a project and you expect to yield an annual profit of 2 lakhs rupees for a period of 5 years because the life of the project is 5 years. Right? You are investing 10 lakhs rupees. You are expected to get an yield of say 4 lakhs rupees every year. 4 lakhs rupees every year. Then for a period of 5 years. Then in how many years you will get back your investment? I repeat, listen it carefully. 10 lakhs is the initial investment. Every year we expect to earn a profit of 4 lakhs rupees for a period of 5 years. Now the question is, in how many years you will get back your investment?
2.5 years.
Exactly, sir. That is the payback period. In 2.5 years, you can get back your money. That is called payback period. If you are acceptable to this is acceptable for you, you can go for the project. Otherwise, you can reject the project. This is the criteria under payback period method. I have given a formula for this. Payback period is equal to initial investment by annual cash inflow. So in this case, initial investment 10 lakhs, annual cash inflow 4 lakhs. So 2.5 years, 2.5 years period, you will get back your money. This period is known as payback period. Then the company will have a decision making criteria that is called cutoff period. If the cutoff period is more than the payback period, then you can accept the project. On the other hand, if the cutoff period is less than the payback period, you have to reject the project. So in this example, the payback period is 2.5 years. Suppose the cutoff period, determined by the company is 3 years, then you can accept this project because they expect to repay it by 3 years, but it is given in 2.5 years itself. So it is less than the cutoff period. Therefore, you can accept the project. On the other hand, if the cutoff period is only 2 years, you have to reject the project. So this is how decision is made under payback period method. So let me just an example is given here. Just go through this quickly, please. 40,000 initial investment, 10,000 every year it is generating for 10 years, but the payback period is only 4 years. In 4 years, you will get back your money. So this is called payback period. Now take up the another example here. Just go through this example, please. A project needs an original investment of 1 lakh rupees. I think it is visible on the screen now. And the
Yes.
annual cash inflows for 5 years are given. First year 30,000, second year 40,000, third year 25,000, fourth year 20,000, and fifth year also 20,000. Now you have to calculate the payback period. See, in the previous example, I told that every year, in the previous example, I just go back to the previous example. Initial investment 40,000 rupees, whereas every year it gives 10,000 rupees as inflow, that is income. So the annual inflow is uniform in this case. It is uniform in this case. Therefore, we have used this formula. Initial investment by annual cash inflow. Straight away, you can use this formula. Whereas, in the current example, the second example, here what happens? The annual cash inflows for a period of 5 years varies from year to year. It is not even. Uneven cash inflows are given. So in that case, you cannot make use of the formula. Rather, you have to find out the payback period in some other method. What is payback period? The number of years in which the initial investment is received back. That is payback period. Right? Now, for the first year, we have 30,000 rupees. Just follow this, please. For the first year, 30,000. In second year, you are getting how much? Second
40.
is 40,000. So totally so far 70,000, right? Then in the third year we got 25,000. So 30 plus 40 plus 25, 95,000 we got so far in the third year. So we need only 5,000 more. This 5,000 you can get out of fourth year inflow. 5,000 out of 20,000. That means 5 by 20, 1/4. So 3, 1 by 4 years, 3.25 years is the payback period. This is how it should be calculated. Let me give you the solution also so that you will be able to understand it. This is how it should be calculated. When the cash inflows are even, you make use of the formula. When it is uneven, then work out like this. Take cash inflows and accumulate the cash inflows over the year. See the year in which the accumulated cash inflows are equal to your initial investment. That year is known as payback period. So here first year we got 30, second year 40, so 70,000, accumulated 70,000, third year accumulated 95,000, fourth year accumulated 1,15,000, fifth year accumulated 1,35,000. We have to find out the year in which the accumulated cash inflows are equal to 1 lakh. So in this example, nowhere it is equal to 1 lakh, either it is less than or more than. Therefore, you have to exactly find out the period in which you can get back 1 lakh rupees. Let me go back to this now. In 3 years, we got 95,000. Am I correct? See, in 3 years, we got 95,000. We need only 5,000 more out of fourth year inflow. Fourth year inflow is 20,000. Out of this 20,000, we need only 5. Therefore, 3 years plus 5,000 by 20,000, this is equal to 3.25 years. I hope you would understand this concept. So this is how payback period is calculated. There is another problem given for your understanding. Just go through this problem. I will explain this. Here two machines are given, machine X and machine Y. And the details of these two machines are given. Life is 4 years, cost is 18,000 and 36,000. Savings in scrap 1,000 and 1,600. Estimated savings in direct wages 12,000 and 16,000. Additional maintenance cost 1,600 and 1,000. Additional supervision 2,400, 3,500. Ignore taxation. This is how it is given. Now we have to find out which project is having lesser payback periods so that can be accepted. So in the previous examples, you are given the cash inflows every year, how much is expected as written is given. But in this problem, we have to calculate the amount and then go for payback period. Here, if you observe the details given in the problem, there are two things are given. One is savings because of using these machines. Because previously they might have used labor intensive technique, manual technique. Now they are replacing, and if you use this machine, there are certain savings. Savings in direct wages, savings in scrap. So the savings are your income. From that savings, additional cost is to be deducted so that you will get the cash inflows. Then with the help of the cash inflow, you can find out the payback period. So take all the savings together. First, let me work out for machine X. Savings in scrap 1000, savings in direct wages 12,000, total savings, that is your total income 13,000. Additional cost of maintenance, additional cost of supervision. Put together 4,000, 1,600 plus 2,400. So out of 13,000, if you deduct 4,000, the remaining amount is called annual cash inflow, that is 9,000 rupees, right? So this 9,000 is the cash inflow. What is the initial investment for this? 18,000 rupees is the initial investment. So what is payback period then? 18,000 by 9,000, 2 years. Like that, you have to work out for the next machine. I repeat, the income in this case is all the savings. So there are two savings given in this. Put together, it amounts to 13,000 rupees for machine X. Then additional cost is the expenses. Two additional costs are given, 1,600, 2,400. Totally it is 4,000. So 12,000 minus 4,000, you will get 9,000 as cash inflow. So in that case, payback period is initial investment, that is 18,000, by cash inflow, that is 9,000. 18,000 by 9,000 is equal to 2 years. Now, can you try for machine Y in a couple of minutes? To try and tell me what is the answer for this second machine.
Three years.
Yes, you are correct. Let me display the answer now. So for X it is 2 years, for Y it is 3 years. X machine X has a shorter payback period. Therefore, it should be accepted. So what is the decision criteria is, earlier the better principle is to be used under payback period method. Earlier the better. So this is how this method goes. Let us move on to the next method. Average rate of return method. Average rate of return method. We have to find out the average rate of return. Let me give an example so that you can find out the average rate of return. Say you are investing 10 lakhs rupees in a project. You are investing 10 lakhs rupees in a project. Yes. Just note down, please. If at all you have a paper and pen, just note down. Initial investment 10 lakhs. Then the amount of investment, the amount of return that you expect from the project, the amount of returns expected from the project. Just note down amount of return expected. First year 40,000. Second year 20,000. Third year 30,000. Fourth year 80,000. Fifth year 30,000. Sixth year 60,000.
So your slide is not shown, sir.
The slide is not, I am telling on my own.
Okay.
I have given only formula here, that's all. So I have given return for 6 years. No, you add up all the returns and find out the average of that.
Sir, can you repeat from the fourth year?
Just I don't have. Just simply I told. What is there? You tell me now. First year how much? First year how much?
So first year was 40,000, second year 20,000, third year 30,000, fourth year onwards I was not able to.
Wait, wait. I will. Second year 20,000. Third year 30,000. Right. Fourth year make it as 80,000. Fifth year 50,000. And the sixth year another 80,000 you put. 40, 20, 30, 80, 50, 80. What is the average of this? Yes, please.
It's around 43,333.
Why, sir? 16 into
43,000.
170. No, no, no.
Sir, 50,000.
It is exactly 50,000. Exactly 50,000, sir.
How, sir? Could you explain?
Total 300. 40,000, 20,000, 30,000, 80,000, 50,000, 80,000. Totally 3 lakhs. 3 lakhs by 6 years. So you will get an average of 50,000 rupees. Okay, now I will go back to the formula. See the formula now. Annual average net earnings by original investment into 100. Your annual average net earnings is 50,000. By original investment 10 lakhs. 50,000 by 10 lakhs into 100. What will be the answer? Yes, please.
5%.
50,000 by 10 lakhs into 100. 5%. Okay. Now you see the next formula. Another R. Another formula alternative is given. Instead of original investment, we have to take average investment. Right? So here 50,000 by average investment means original investment by 2. Original investment is 10 lakhs. If you want average investment 10 lakhs by 2, you will get 5 lakhs. So 50,000 by 5 lakhs into 100. Now the percentage is 10%. Right?
Yes, sir.
So here, based on the rate of return, we have to take a decision. The management always will have a cutoff rate. Suppose that the cutoff rate of the company is 8%. 8%. Then, if your actual rate of return is more than that, you can accept the project. If it is less than that, you have to reject the project. Two methods are actually there. You can use any method which is asked in the examination. Any one method which is asked. So the rate of return you have calculated is more than the cutoff rate, you accept the project. The company expects 8%, but if you earn 10%, you can very well accept them. On the other hand, when the company expects 8%, if you earn 5%, it should not be accepted. So this is how it should be decided. Then comes the another method, that is sophisticated or discounted cash flow techniques. Now let me conclude this traditional techniques, that is an urgency method, payback period method, and average rate of return or accounting rate of return method. So leaving that urgency method, because that is not a quantitative method, it is qualitative method, so that can be left out of our discussion. Under two methods, payback period method and accounting rate of return or average rate of return method, what is taken care of is present value of money is not considered. Present value of money is not considered. What is present value? Every year we expect to earn 2 lakhs rupees as income. Now the question is, suppose that the project has a life of 5 years. Every year it is expected to earn an annual income of 2 lakhs rupees, right? Now the question is, the amount of 2 lakhs rupees that you are going to get at the end of 5 years and the amount of 2 lakhs rupees that you are going to get at the end of first year. In every year you are going to get 2 lakhs rupees. The question is, the amount that you are going to get at the end of fifth year and the amount that you are going to get at the end of first year, both are equal in number, that is 2 lakhs, 2 lakhs. My question is, are they both equal in value? By number it is equal, 2 lakhs, 2 lakhs. My question is, are both these 2 lakhs are equal in their values?
No, sir.
Why?
So because of time value of money concept, the 2
What
lakh
you
rupees,
understand by the time value?
sir, the 2 lakh rupees which we will be getting at the end of first year will be more valuable as compared to the 2 lakh rupees which we will be getting at the end of 5 years.
How I am asking this one? That's what.
So actually, due to inflation and opportunity
Yeah.
cost,
Now,
the
listen. Just a minute. Sorry to interrupt. Assume that there is no inflation in the country. Now, can you tell that both the values are equal or not equal? Your point is correct. When there is inflation, the value will reduce. Okay, I accept that. But assume that there is no inflation in the country. Inflation remains the same all these 5 years. Then can you say that both are equal? Yes or no?
I think so, sir.
Now also they are not equal. Here the question of inflation is not taken into consideration. Rather, the amount of returns that you have foregone for this future period that is called opportunity return. That will be taken into consideration. Let me just simply explain this concept. Had it been given in the first year itself instead of fifth year, you would have invested this money into some avenue and earned some revenue out of that. That earning is foregone. The foregone amount of interest or income is the loss for the company. Therefore, suppose that if you get 1 lakh rupees now and invest it in some investment, you can get a return of 10%. How much you will get?
10,000 rupees.
10,000 will get. So at the end of the year, what will happen is 1 lakh will become 1 lakh 10,000. Correct? Again,
Yes,
if
sir.
you invest this 1 lakh 10,000, you will get a return of 11,000 rupees for the next second year. So 1 lakh 21,000. It will become 1 lakh 21,000. So in the second year end, it is 1 lakh 20,000. That is future, right? What is the present value in the first year? That is 1 lakh rupees. So future inflows of 1 lakh 21,000 is its present value is 1 lakh rupees. Now, if you keep the same 2 lakhs at the end of fifth year, it will not be equal to 2 lakhs in the beginning of first year. It will be less than that. Therefore, you are losing the income that would have been earned had it been given earlier itself. That is foregone. Therefore, the value is reduced. Now, that method is known as discounted cash flow techniques. So here, based on the return on investment expected, you have to discount the future value to its present value. Future inflows to its present value. One of these methods is called net present value method, which is very important from the examination point of view. Net present value method. So the problem is given now. go through this problem. If you have study material, you can open that this problem is there in your study material. So here two alternative machines are given, machine X and machine Y, and initial investment is 20 lakhs rupees. Each project requires 20 lakhs. These are called mutually exclusive projects. Either you can invest in X or either you can invest in Y. You cannot invest in both. You have to choose one among them. And it requires 1 lakh rupees additional working capital at the end of the first year. Now, earnings after taxation are expected to be as follows. It is given 5 years earnings are given. Shall I proceed now? Just go through the problem quickly, please. Shall I proceed?
Yes, sir.
And the company has a target rate of return of capital is 10%. You are required to prepare the profitability of the machines and state which alternative you consider financially preferable using NPV method, net present value method. This present value table is given. That is, if you invest 1 rupee in the beginning of the first year, at the end of the year it will become 0.91. The present value is 0.91 because rate of return expected is 10%. That is given in the beginning, 10%. So if you discount it by 10%, you will get 0.91. The 0.91 again 10% discount will become 0.83. Like that it goes on. By making use of these values, we have to find out the present value and take a decision. So now let me move on to the solution part of this. This is how it is worked out. So we have taken two machines here, machine X and machine Y. These are the two things we have taken. 5 years are taken here in the first column. Second column is meant for discount factor. That is given in the problem itself, discount factor. Cash flows of machine X and cash flows of machine Y are written now. And these cash inflows are multiplied with this discount factor, you will get present value. Cash inflows are multiplied with this present. For example, for machine X in the first year, cash inflow is 2 lakhs. This 2 lakhs is multiplied with 0.91 present value factor. So you will get 1,82,000. Similarly, if you take the case of machine Y, we have 6 lakhs rupees cash inflow in the first year. That 6 lakhs is multiplied with 0.91. You will get present value of 5,46,000. Like that, the present value of cash inflows are calculated for all the 5 years for two machines. Just go through that. So all the 5 years present values are added together. For machine it is 25,92,000. For machine Y it is 26,16,000. Right? We take only present value. Don't go for cash inflows. Present values of X 25,92,000. Present value of Y 26,16,000. Now, similarly, from this total present value of cash inflows, we have to detect total present value of cash outflows. Outflow is 20,000. 20 lakhs rupees. Initially, we have made an investment of 20 lakhs rupees. 20 lakhs will be taken asset, but because it is invested in the 0 year, that is beginning, in the beginning. Therefore, it is taken asset. Now, 1 lakh rupees is invested additionally at the end of the first year. That is what given in the problem. I will just go back to this. You see here in this problem, requiring 1 lakh rupees additional working capital at the end of the first year. So this outflow is also to be discounted to its present value. So 1 lakh rupees at the end of the first year means we have taken discount factor of first year 0.91. 1 lakh into 0.91, it will become 91,000. So 20 lakhs from plus 91,000, the total outflow is 20 lakhs 91,000. Similarly for Y also 20 lakhs 91,000. If you subtract total present value of cash outflows from total present value of cash inflows, you will get net present value. I repeat, total present value of cash inflows minus total present value of cash outflows. That is for machine X, 25 lakh 92,000 minus 20 lakh 91,000. You will get 5 lakh 1,000. Similarly for Y, 26 lakh 16,000 minus 20 lakh 91,000, you get 5 lakh 25,000 as the net present value. Now that based on this net present value only, we have to take a decision. What is the decision here? The project whose net present value is higher than the other will be accepted. The project which is having more or higher net present value will be accepted. So project X, machine X, net present value is 5 lakh 1,000. Machine Y, net present value is 5 lakh 25,000. Which is to be accepted now?
Machine Y.
Machine Y.
Machine Y.
This is how the decision is taken under net present value method. This method can be expected in the examination. Just go through again. I will keep the slide now. Take 2 minutes, go through this, try to understand. If at all any doubt, you just ask me now.
So the discounted factor will be given, sir.
Yes, it will be given. Suppose if it is not given, what is to be done? You have to use one formula. That formula I will give you now. Just a minute, please. Is it visible on the screen now?
Yes, sir.
Yes, sir. Yes, sir.
This formula you have to use. Present value factor is 1 by 1 plus r power n. It is not 2 r power n. Just a minute. To make it as r power n. Now you can try to use this formula and find out. You take the case of, say, second year. I will tell you how to use this formula. PV factor for second year. Let me work out and tell you. You can also try. One of you can try this PV factor for the second year. That is, R is equal to rate of investment. N is equal to number of years. So in this case, rate of investment is 10%. That is given in the problem. That should be given in the problem. You cannot take it as your on your own. Similarly, Number of years you can put it, whether it is for first year or for second year or third year, you can go and change this. So 1 by 1 plus 10 by 100 power 2, that is the application for second year. 1 plus 10 by 100 power 2. If it is for third year, you make it as power 3. Is it visible? Is it visible on the screen now?
Yes, sir. Visible.
Now you just find out the value of this. Let us see whether you are getting the same thing.
0.82.
Yeah, 826. No.
Yes, sir.
Yes. So that is given as 83. You refer to the value given in the example. What is given in the example? Is it 82 or 83?
0.83.
Yeah, if you take 3 digits, it is 826. If you take 2 digits, 83. That's all. This is how you have to calculate. That's all. So is it over now? Shall I move to the next one?
Okay, sir.
So this is where we have stopped. Shall I move to the next one?
Yes, sir.
The next one is excess present value index or benefit cost ratio, otherwise known as profitability index method. Otherwise called the profitability index method also. Profitability index method, PI. There is a formula for this. Present value of future cash inflows by present value of future cash outflows into 100. Now, I just request you to make use of the previous problem and apply this formula for machine X and machine Y separately. Tell me what you are getting as answer. Make use of the solution given in the previous problem, because for this method also you have to find out the present value. There we have calculated present values in the net present value method. Now, making use of the same information, you can find out the profitability index for the same measures, and based on that you can take a decision. Now you find out profitability index for machine X and machine Y separately and tell me now how much it is. For say, let me explain. For machine X, the formula is present value of future cash inflows. How much is the present value of future cash inflows for machine X? Tell me how much it is.
25,92,000.
Yes, 25,92,000 by 20,91,000. The other one is 26,16,000 by 20,91,000. You find out the answer and tell me how much you are getting. One point.
1.23 for X.
Yes, sir. Other one.
$1.25.
Which is to be accepted means this is called index, no? Profitability index or benefit cost ratio. The project whose index is higher than the other will be accepted. So which is to be accepted then?
Y.
Y. So in this problem, as far as this example is concerned, under net present value method as well as under the excess of present value index method also, we are getting the same answer because the initial investment is same under both the cases. So when initial investment are same under both the cases, you need not go for this method, profitability index method. What the answer you are getting in the net present value method will say the same will be getting under this method also. Then why this method is given then? If at all the investments vary from project to project, for X suppose it is 20 lakhs, for Y it is 25 lakhs, something like that, then you have to use this method instead of net present value method. Why? Because when the investments are more, naturally the income also will be more. Whereas if you take it in relative terms, that is the ratio bit proportionate terms, then only we can compare them under the uniform platform. That is the reason why when the investments vary from project to project, then resort to this method, excess present value index method, instead of net present value method. Because for both this method, you have to calculate net present value only. So finally, you find out the ratio, that is index, and based on that you decide. So this is excess present value method or benefit cost method. Now comes internal rate of return method. I think it is visible on the screen now. Internal rate of return method. Is it clear? Is it
Yes, sir,
clear?
visible.
Yes. Okay. Now that let me say what this internal rate of, this is another important area where you can expect problem in your examination. That very clearly it is given in your syllabus. In both these cases only problems will come. That is net present value method as well as internal rate of return method. So just go through the problem. I will explain you what this internal rate of return method and how it is to be worked out. So what this internal rate of return is, means the rate at which the net present value is equal to 0 is called internal rate of return. The rate at which the net present value of the project is equal to 0 is called internal rate of return. So what is the meaning of net present value is equal to 0? That means, how do you get the net present value? Can you tell me the formula to get net present value? We have calculated the previous problem.
Cash inflows into discounted factor.
I repeat, just note down if you want. Total present value of cash inflows minus total present value of cash outflows. To keep it in mind, simply inflow minus outflow. Inflow minus outflow. You take present value of inflows and present value of outflows. Don't take assets. Take the present value of inflows minus present value of outflows. You will get net present value, right? So if it is equal to 0, that means net present value, when present value of inflows must be equal to present value of outflows. Then only net present value will be 0. Do you agree with that?
Yes, sir.
Yes. So you have to find out that rate. That is called internal rate of return. The rate at which the total present value of cash inflows are equal to total present value of cash outflows. That means NPV is equal to 0. If you find out that rate is called internal rate of return. Based on that, you can take a decision. This is how we have to do this. Okay. Now, let us move on to this problem. A company has to select one of the following two projects. Right? Use internal rate of return. Suppose that is the question given. Is it visible now? Clear now? I think this problem is there in your study material. You can take up that also. Yes, it is there in your study material. Please take up your study material so that it will be easy for you to go through that. Now, in the net present value method, you will be provided with the rate of return. That is discount factor, otherwise known as cost of capital, otherwise known as rate of return, return on investment. These are all different names. 10%, 12%, something like that will be given. Based on that, you will take present value factor that is given in the problem itself 0.91, 0.83, 0.75, something like that. So, making use of that value, you found the present values and took a decision. Here, the rate itself we have to find out, and then present values are to be calculated. Whether it is 10%, whether it is 11% or 12%, what will be the rate? That rate itself we have to find out. It is a very difficult task. Therefore, we use trial and error methods. Trial and error method. Suppose that somewhere we start and from there we proceed to reach the exact rate. It may be completed very quickly or sometimes it may take a lengthy time also. So in that case, we have a shortcut to use this. See this. Use the formula F is equal to I by C. Is it visible on the screen now? To find out this internal rate approximately, this formula is to be used. F is equal to, that is factor, present value factor is equal to I by C. I means initial investment, C means cash inflows, annual cash inflows, right? Now, let us go back to this problem again. Take the case of first project, project A. How much is the initial investment?
22,000.
22,000 divided by average cash inflows are to be put. The inflows are given for 4 years, 12,000, 4,000, 2,000, 10,000. Find out the average of this.
7,000.
7,000.
Now F is equal to I by C. 22,000 by 7,000. See this, you will get 3.14. Right? Similarly, you go for project B also. Initial investment 20,000. You find out the average return for the 4 years 2,000, 2,000, 4,000, 20,000. This is also 7,000. But initial investment varies. So the F factor will also vary. 2.86. Right? Shall I proceed now? We have to find out this factor, F factor, that is helpful for us to locate the rate easily. So, shall I proceed now?
Yes, sir.
Now, I have taken project A. This value, no, what is the value for F value for project A? 3.14, no, 3.14. So now we have to refer to the discount factor, that the PV factor table is there, present value table is there. In that table, you have to refer where approximately this 3.84 lies. I think now that at present I don't have the table with me, let me just show you the table, how to locate it in the next class. Now just listen. 3.14. 3.14 is the F factor. Now in the present value table, we have to locate approximately where this 3.14 lies. Means now you can see the slide. In case of project A, the rate comes to 10%, while in case of project B, it comes to 15% approximately. It's not exactly, approximately 10% and 15%. So for project A, we have to take 10% rate. 10% rate. For project B, we have to take 15% rate. The present value factor that is given in the previous problem itself. In examination, in the problem of IRR also, you will be given the rates. That is, discount factor will be given to you. Now, in this case, 10% is the present value factor, that is discounting factor. So by taking 10% into consideration, we have to find out the present value for project A, as we did under net present value method. See, 4 years, 12,000, 4,000, 2,000, 10,000 are given. Discounting factor approximately it is taken as 10% based on F value. The present value factor here is given 0.909, 0.826, 0.751, 0.8683. So in the previous problem also, we have taken 10% as the present value factor, whereas it was given as 91837568. There 2 digits are given, here 3 digits are given, same 10% only. Now we have to find out the present value and net present value as we did in the previous problem. So this cash inflow of each year is to be multiplied with the discount factor of each year. You will get present value for each year. Sum up all the present values of 4 years. You will get 22,544. Cash outflow 22,000. That is initial investment. So net present value is 544. This problem is there in your study material. If you have study material, just simultaneously refer to it, please. Are you able to understand up to this?
Sir, the discounting factor is given in the question,
Which one,
or
sir?
we have to calculate?
Which one?
Discounting factor at 10% is
The
given, or
discounting
we
factor that will be given in the problem itself. In the
okay.
examination, you will be provided with this. If not, you can ask for present value table for your reference. The examination center, it will be supplied if it is not given in the problem. Shall I proceed now?
Yes, sir.
Yes, sir.
Yes, sir. So the present value, net present value at 10% is equal to 544, which means it is not the internal rate of return. Am I correct? Because you should not get any present value. Net present value should be 0, but you are getting 544. Therefore, we can take it as approximately 10%. That's all. It is not exactly 10%. So to find out exactly what is the rate, now we have to move into higher percentage from 10 to 12 or 13, like that. We have to move further so as to reduce this net present value to 0. This 544 should be brought down to 0. If you take 10%, you are getting 544. If you take 11%, you will get less than this. If you get 12%, still you will get less. If you get 13%, still you will get less. So where it is equal to 0, that we have to find out. So 10% it is not equal. Okay. Let me take up 12% now. See, the same problem I am continuing with 12% instead of 10%. The present values I have taken from the table. These values, discount factor 12%, 0.893, all these things we have taken from the table. I will let you know how it is to be taken from the table by tomorrow's class. Because right now I don't have the value with me. Tomorrow I will tell you how to see that. So we find out the present value at the rate of 12%. Now what happens? It goes minus. Negative net present value comes. So if you take 10%, your net present value is positive and is not equal to 0. Okay. If you go for higher percentage, I am taking approximately 12%. That is why I told in the beginning it is only trial and error method. Approximately only we can find out with the F factor. Then we have to go with the help of trial and error method. Now I have taken 12%, so to reduce this value, it has become negative now. That means this exact rate lies between 10 and 12%. That is the meaning of it. Lies somewhere between 10 and 12. So we have to find out exactly where it is. Shall I proceed now? Just go through this. First, we have calculated 10%. As the net present value is more than the 0, we proceeded with higher percentage. We have taken approximately 12%. Now 12% you are getting negative present value. Therefore, we presume that the exact rate is lying between 10 and 12. That we have to exactly locate. For that, there is a formula. That formula I am going to use and tell you how to find out exact rates. So this is a formula to be used now. If you find the range, then to find out the exact rate of discounting factor, use this formula. Is it visible on the screen now, this formula? IRR is equal to lower rate plus present value of lower percentage minus required net cash outlay by difference between the present values of both into difference in rate. Is that we have taken two values, 10% and 12%. Which is the lower rate among the two? See, we have taken 10% and 12% under trial and error method. Which is the lower rate among the two?
10%.
10%. So we start with lower rate. See the formula it is applied now. 10% plus present value of lower percentage. Say at 10% present value is 22,544 minus net cash outflow, that is 22,000. Initial cash outflow 22,000, right? Divided by difference between the present values of both the rates. Under 10% present value is 22,544. Under 12% present value is 21,688. Difference between these two into difference in rates. Difference in rate is 10% and 12%. Difference is 2%. So into 2%. Now if you say simplify that, you will get the answer like this: 11.27%. That is the answer for this. 11.27%. So at exactly 11.27%, the net present value of this project will be equal to 0. That is the meaning of it. So this we have found out only for one project, that is project A. Like that, we have to find out for project B also. Just take it as an exercise and do it, and tell me tomorrow if there is any difference. It is there in your book also. You can refer and do it now. Shall I proceed?
Yes, sir.
Okay. Now, these are the various methods under certainty. That means, I said every year we expect to earn some amount of inflow, cash inflow. So in the problems also it is given. First year this much, second year this much, third year this much, something like that. Okay. That means we are certain about future cash inflows. But in practice, always you cannot be certain about future cash inflows, because the future involves risk factor. You may expect something uncertain, some unexpected things may happen. So under the situation of uncertainty, how this capital budgeting decision will be undertaken. That means We have to incorporate risk factor also while taking decision under capital expenditure proposals. Some of the popular techniques used for this purpose are now given. Just let me go through this quickly. Under uncertainty, these techniques are being used in addition to the traditional techniques. Risk adjusted discount rate. What is that risk adjusted discount rate? Say in the problem I told you that the rate of return is given 10%, 12%, something like that. That is called discounted rate, otherwise known as discount rate or discounting factor, otherwise known as rate of return, otherwise known as cost of capital. So in all these previous problems, that discount rate is given in the problem, like 10%, 12%, something like that. We have taken present value factor from the table and we found out the present values and take addition. Now, risk adjusted discount rate. What the rates given under the previous method are called riskless discount rate, 10%, 12%. No risk factor is involved. As you expected, you can get 10%, 12%, 15%, whatever is expected, you will get. That is called riskless rate. Suppose that if there is a risk, if there is a risk, how much percentage of risk you expect, that is to be forecasted. Suppose riskless rate is 10%, you are giving risk premium, say 3%. 3% risk I am expecting. Then you have to adjust this risk rate along with riskless rate. Then it will become 13%. I repeat, riskless rate is 10%. That means 10% if I expect, I will get 10% definitely. Certain. Riskless, no risk. But if you take the amount of risk also, how much risk you want to take, how much risk is expected rather. Say I expect 3% risk. Then the rate is 10 plus 3, 13%. This is how you have to take. And then net present value method, all these methods can be worked out. That is risk adjusted discount rate method. I think you are able to understand this. Then certainty equivalent coefficient. Certainty equivalent coefficient. I will show the slide now. Say for example, let me give an example so that you can understand this. Suppose that normally we expect 1 lakh rupees as the cash inflow in the first year, right? Normal expectation of your cash inflow in the first year is 1 lakh, right? Are you certain about that? If I ask, no, I am not certain. To what extent you are certain to get 1 lakh rupees means I said only I think 90% I am certain. So in that case, instead of 1 lakh, we take only 90% of that. Suppose in the second year you expect 1,20,000. Again you ask, what is the certainty of this 1,20,000? No sir, only 85% I am certain. Then you take only 85% of 1,25,000 as cash inflow. So this is how we have to convert this uncertain cash inflows to certain cash inflows. I repeat this example. If you expect 1 lakh in the first year, if I ask you that, are you certain about this? You say, no, I am not certain about this. To what extent you are certain then? I say, I am 90% certain about this. So you take only 90% of this. On the other hand, in the second year, you are only 85% certain about this. You take 80%, 85% of the cash inflow for the second year. Third year, if you are certain about 95%, you take 95%. So convert this uncertain cash inflows to certain equivalents. That is called certainty equivalent coefficient. Then you can proceed with net present value method or something like that. Then comes sensitivity analysis. What this sensitivity analysis says, your forecast about the future cash inflows. It says about your forecast about future cash inflows. I said next to 5 years you can expect 2 lakhs rupees, or next to 6 years you can expect 10,000 rupees every year. Then all this your forecast only. These forecasts are subject to certain sensitivitiness of the business. What the sensitivity is. Suppose that I am telling 1 lakh rupees is the my expectation as the cash inflow of the first year. Right? 1 lakh rupees is my expectation. Or every year I expect 1 lakh rupees. Now, if the market is sensitive, responding to the sensitiveness of the market, then you have to reforecast your, say, cash inflows. How to reforecast it? Most likely optimistic and pessimistic. Most likely I can expect 1 lakh rupees. Normal, under normal conditions, I can expect 1 lakh rupees. If pessimistic situation arises, that means everything goes wrong. The market is dull, demand is less, no supply, no income, nothing like that. Everything goes wrong. Then how much you expect? Then in that case, I expect say 75,000 only. Then optimistic, if all the conditions are positive more than your expectation, then you will expect more than your normal expectation. That is, instead of 1 lakh rupees, I can forecast 1 lakh 20,000 rupees. Like that, we make three estimates based upon different sensitiveness of the market. One is optimistic estimate, other one is pessimistic estimate, other one is most likely estimate. Based on this, you have to take a decision, that is called sensitivity analysis. Then probability assignment, next method, probability assignment. I said in the first year I am going to expect 1 lakh rupees. Probability, because it is all future expectation only. The very nature of future is uncertain. So probably if something goes wrong, how much you will get? So you expect the probability of 1 lakh rupees. It is 90%, that is 0.9. So it will be 90,000. So in the second year, the probability is 80%, so 0.80. Like that, you assign probable variable for this expected cash inflows. Then based on that, you calculate the cash inflows and work out the net present value, all these things. Then standard deviation. You find out the standard deviation of the different projects. Whose standard deviation is less than the other will be considered. Then coefficient of variation. The standard deviation along with mean. You will get coefficient of variation. So the project whose coefficient of variation is less will be accepted. So decision tree is another diagrammatic method that should be used for taking decision under uncertainty. So these are all different methods used for this capital expenditure proposal evaluation. So now let me move on to the last part of this unit, that is social cost benefit analysis. Social cost benefit analysis. Just a minute, please. I think it is visible on the screen now. Social cost benefit analysis. Is it visible? I think it is visible. Okay.
Sir, visible, sir.
Yes, I will continue. So it is a tool used to assess the economic and social implications of an investment in a project by comparing the total expected cost with total expected benefits for a society as a whole. That is called social cost benefit analysis, SCBA. I repeat, it is an assessment of the economic and social implications of a project by comparing total expected cost, that is amount of money to be spent, with that of total expected benefits for the society as a whole. This is called social cost benefit analysis. To put it in a very simple terms, is the project socially worthwhile? That's what we are going to find out this. The key elements of the social cost benefit analysis. Key elements, key components, key components of social cost benefit analysis. Just a minute, please excuse me for a minute. I will come back. So key components. Identification of cost and benefits. How much is the cost, private cost, and how much is the private benefit? How much is intangible cost and intangible benefits? How much external cost involved and external benefits? These are to be separately identified. Then monetizing the cost and benefit. At market prices, it should be monetized. And there is another method called willingness to pay method. So under this method also you can monetize. That is, find out the monetary value for benefits. Then human capital approach. This is another method wherein you can find out the value of the benefits. Then discounting future cost and benefits. Now that we have completed under net present value method, find out the present value of future benefits. So these are the various components of key components of social cost benefit analysis. What are the steps involved in social cost benefit analysis? Steps involved in this. These are the steps to be taken. One is define the project or the policy very clearly. It is clearly outlining the project being assessed, its objectives, timeline, scope, everything is to be very clearly defined. Then identify and estimate the cost and benefits. As far as cost is concerned, what is the direct cost, what is the indirect cost, what is the direct benefits, what is the indirect benefits, all these things are taken into consideration. For example, say construction cost how much, operational expenses how much, they are called direct cost. Under indirect cost, we have social impact or environmental impact on the society, for which how much is the cost. Then direct benefits, it is increased productivity or improved infrastructure, these are all direct benefits. Then indirect benefits, better air quality, reduced health care cost, reduced pollution, these are all indirect benefits. So all these things are to be identified and estimated. Then assign monetary values for this. So you can put monetary value, that is for many goods and services, cost and benefits can be easily valued using market prices. So use market price and value, find out the value of this. Sometimes you have to use non-market valuation techniques also to estimate the values of intangible impacts. The impact on environment, environmental preservation, or improved quality of life, that can also be found out. So first step, define the project. Second, identify and estimate the cost and benefits. Third, assign monetary values either based on market price or non-market values. Fourth one, discount future cost and benefits. That is present value of future cost, future income is to be identified by taking suitably some discount factor, say 10%, 12%, like that, as we did in the capital budgeting technique. Then compare the total cost with total benefits. You will get net present value, as we did in the net present value method. All the present values of benefits minus present values of cost. You will get net present value. Or you can find out the profitability index, benefit cost ratio also. A ratio greater than 1 indicates that benefits exceed the cost. When the benefits exceed the cost only, this project is to be accepted. Then assess distributional impacts. How cost and benefits are distributed across different sections of the society, like rich and poor, urban and rural, all these things. That is to be assessed. How much how much or to what extent it is being distributed among the various sections of the society. So these are all the steps involved in this. Applications of social benefit cost. Applications. Infrastructure projects. Under infrastructure projects, it can be applied. Say large scale infrastructure projects like construction of highways, public transit system, airport, water treatment plants, bridges, dams. Under these cases, you can go for social cost benefit analysis. Then environmental policies, projects involving environmental policies, evaluating the cost and benefits of regulations aimed at reducing pollution, conserving biodiversity, mitigating climate change. So these are the projects undertaken. There also you can use socio cost benefit analysis. Then in public health programs also you can go for this. That is assessing the societal impact of healthcare initiatives. Say, for example, vaccination campaign is undertaken. What is the social impact of this? Our health education awareness program is conducted. What is the social impact on this? This can be analyzed, assessed. Then under social programs also. So, for example, welfare policies or education reforms or poverty reduction programs are conducted. In that case, how it is being creating an impact on the society. What is the social benefits and social cost that can be analyzed? So these are the areas in which it can be applied. So this is about social cost benefit analysis. Now let us move on to the fourth unit, please. Just a minute. In few minutes I will come back to this. I think now it is visible. Unit number 4. So unit structure. Developing project network using either CPM or PET. Trashing of projects, project appraisal, project control process, project audit. These are the concepts to be discussed under this. Developing project network. Let us move on to this now. Is it visible on the screen now? Developing a project network.
Yes, sir.
Okay. Okay, thank you. So developing a project network is a critical step in the project management, particularly in scheduling and ensuring that tasks are completed in the most efficient sequence. This project network helps to visualize the interdependencies of various tasks and define the critical path of the project. What is network means? A network is a series of related activities and events which result in an end product or some service. I repeat, network is the diagrammatic representation of series of related activities and events which will result in an end product or service. So these activities shall follow a prescribed sequence. That is very important. Say, for example, take the case of construction of a house. You want to construct an house. What are the various activities to be performed? These activities are to be listed down sequentially in an order. Say, for example, let me say like this. As far as possible, let me put it in a sequence. Laying the foundation should take place first before construction of walls. Fitting water taps will be done towards completion of the construction. So this sequence cannot be altered. So for example, you cannot first of all fit the water taps and then construct the walls. It cannot be done like this. Sequence is to be followed. So that is called network. Okay. Now, now let me explain how a project network is being constructed. Just a problem is given which you have already studied and passed the examination in your second semester. Let me quickly go through this so that you will have the benefit of hearing that. This comes under operation research in your second semester, which you would have completed now by now under network analysis. It comes under network analysis, CPM and PET. Say, this is the problem given now. Is it visible now? Otherwise, I will take up the other study materials. Is it
Yes, sir, visible.
Clear? No? Clear.
Yes, yes, sir.
Okay. So here you have to construct the network diagram for project with the following activities. I will just read the problem, carefully listen to it so that I will explain how to draw this. First of all, we have to given activity. Name of the activity is A. Any activity under construction of network has two events, start event and end event. For activity A, start event is 1, end event is 2. That is why it is given as 1 to 2. Then for activity B, start event 1 and end event 3. For activity C, 1 to 4. D, 2 to 5. Now what happens? Immediate predecessor activity is given in the next column. For activity A, B, and C, no immediate predecessor activities are given. That means all these activities are commencing from the same point. That is the meaning of it. There is no predecessor activity. Before that, there is no activity. They are the initial activities. A, B, and C. All the three are initial activities. But D comes from A. That means only after completing A, you can go for D. Similarly, E comes from B. B is the predecessor activity of E. That means B should be completed first, then E will follow. Similarly, F follows C. G follows D. So these are the various activities given. We have to construct a network diagram. See the diagram now. So go back this problem. The diagram is given like this. A, B, C. There is no predecessor activity. The events are given 1 to 2, 1 to 3, 1 to 4. They are named as A, B, C. So 1 is the starting event, and from that 3 events are branching out. That is 1 to 2, 1 to 3, 1 to 4. 1 to 2 is A, 1 to 3 is B, 1 to 4 is C. Is it clear now?
Yes, sir, clear.
Now, D comes from A. See, D comes from A. That is 2 to 5. Then E comes from B. B is 1 to 3. From that E comes. That is 3 to 5, 6. Then F comes from C. that is 4 to 6. Then G comes from D. So G comes from D, E comes from B, F comes from C. That's all. With that, it is over. Therefore, all these three activities should end somewhere at the same point. That is why end event is 6. This is how this is constructed. It is constructed now. This you have done under your operation research. Same thing, only here it is given again. So let me go through this quickly. Are you able to know how to construct this now?
Yes, sir.
Yes, you can sit at home, take your operation research material, and some more problems are given in that. You can work, right? I mean, practice them, so that if it is asked in the exam, this is also another important area which may appear in your examination question paper. So you can practice that. Okay. The next one, I will give another problem, a simple problem. Can you work out now immediately? Take some 5 minutes and work out now. This is the problem now. Ah. Try to work out this, so that you can, once I give the answer, you can know where you are not able to understand. Just 5 minutes, maximum 5 minutes. It is my request that, if possible, tomorrow when you come to the class, you bring your operation research material, so that I can work out the problem from the study material. That will be easy for you to understand the concept instead of putting in the PPT. You just draw a diagram for this problem. Whatever you can do, you just do it. Let us see at the end where you are able to complete that, or where you are not able to do that. Let us see now.
Finished, sir.
I will show the answer now. You can see that. See the answer and make a correction if required. Shall I move now further?
Yes, sir. Yes, sir.
Okay. Next problem. It is given along with the duration. That is the difference. Along with the duration. Okay. So let me explain this and complete this. So when in the previous problems, no duration is given. Here duration is given. So in the same way, we have to construct the diagram. See the answer now. This is the answer. This is how it is constructed. Name of the activity is given above the arrow, and duration is given below the arrow. This is how it is given. Just note down this diagram quickly. Here the line is omitted. 5 to 6 you have to draw the arrow. Just note down in your paper so that the next part we can explain easily. Now from this diagram, say we have to find out the critical path. That is the decision here. Critical path method. Critical path is to be ascertained. That is the path through which the project goes through from the beginning to the end is called path of the project. You may have different paths. You have to find out the critical paths. Say for example, start event 1, end event 6. Say from 5 to 6 you draw the line. It is omitted in the diagram. You draw the line between 5 to 6. Arrow is to be given. 5 to 6. Below F and above 4. Let me explain the path now. Say start event is 1, end event is 6. So you have to start from 1 and reach 6. That is the path. You have to start from 1 and reach 6. Which path you are going to take? There may be more than one path, more than two paths, more than three paths. We have to find out all the paths and find out the critical among them. Say I will take first path 1 to 2, 2 to 3, 3 to 5, and 5 to 6. This is how I am going to travel. Repeat, from 1 I have to reach 6. So I am taking the route like this: 1 to 2, 2 to 3, 3 to 5, 5 to 6. This is how I am going to travel. Is there any other way to reach 6 from 1?
Yeah, yes, sir.
Yes, what is that?
1 to 2, 2 to
Yes,
4, 4
yes,
to 5, 5 to 6.
yes, exactly. So there are two paths. Is there any third path?
No, sir.
No. Now let us take the total of the time that we require to travel from 1 to 6 in each path. Say I will take the first two path: 1 to 2, 2 to 3, 3 to 5, 5 to 6. The time is 3, 5, 10, 4. 3 for A, 5 for B, 10 for B, and 4 for B. What is the total time taken?
22.
22. Okay. Days are be something like that. 22. Now for the second path,
19.
19. So which is the critical path? Means the path which takes highest time, longest duration, is called critical path. Then which is critical path? 1 to 2,
First
2 to 3, 3 to 5, 5 to 6. First path is
22.
critical path, right? That can be shown in, say, thickened lines or different color, something like that. So here you see how the path is arrived at. Two paths are arrived at. Path 1 and path 2. See this now. I think it is this. This is how you write the paths. And finally, the critical path is 22. In 22 is the first path is critical path. First path is critical path. The activities involved in critical path A, B, D, and F. These are called critical activities. I repeat, activities coming under critical path A, B, D, and F are critical activities. And those activities which are not falling in the critical path are called non-critical activities. Say for example, in this problem, C and E are non-critical activities. Am I correct? A, B, D, F are critical activities. C and E are non-critical activities. right? The activities falling on the critical path are critical activities. So we have to find out the critical activities and non-critical activities. Why? Because critical activities take the longest duration. Non-critical activities not taking longest duration. There is a gap between this. Say this is 19 weeks, that is 22 weeks. 3 weeks are there gap as a gap in between. So non-critical activities C and E can be delayed to some extent, 2-3 weeks maximum. That will not affect your project, because only when you complete all the activities that is critical A, B, D, F, the project will be completed. So if there is a delay in performing non-critical activities, that will not affect the project till it does not exceed the critical duration, that is project completion duration. The project completion duration in this case is 22 weeks. Are you able to understand the concept now?
Yes,
Critical,
sir.
non-critical. Okay. This is what I have given here. Just go through this quickly. 1 minute, please. If you delay the critical activities, then complete project will be delayed. Therefore, that is called critical. You should be very careful in performing this, completing these activities. You should not make any delay in between the critical activities. But non-critical activities may be delayed to some extent. It will not affect the completion of the whole project. Okay. Let us move on to the next part of this. Shall I complete one more concept?
Yes, sir.
Okay. I think it is visible now on the screen. PET,
Yes, sir.
program evaluation and review technique. PET. So far, what we have discussed is critical path method (CPM). Now, program evaluation and review technique. This is also another network analysis. The main difference between these two is same way we have to work out all these things. The only difference is under CPM, that is critical path method, the assumption is that precise time estimate is available for each activity. I said 3 weeks, 4 weeks, 5 weeks, 10 weeks, 2 weeks, like that. Time is given, duration is given. The duration can be estimated precisely. Then you can use critical path method. On the other hand, if one finds very difficult to find out the precise time estimate for an activity, then we resort to the help of program evaluation review technique. So under this method, if it is not practically possible to have precise time estimate of future activities, then 3 time estimates are made possible under this. Multiple time estimates approach is followed here. Probably 3 time estimates. That is it visible now?
Visible, sir.
3 time estimate. Pessimistic time estimate, optimistic time estimate. Visible now? Okay. So this
Yes, sir. Visible.
yes, pessimistic time estimate is denoted as PP, right? Optimistic time estimate is denoted as TO. Then most likely time estimate is denoted as TM. The optimistic time estimate is based on the assumption that an activity will not involve any difficulty during the execution of the project, and therefore it can be completed within the short period. That is called optimistic time estimate. Then pessimistic time estimate is based on the assumption that there would be always unexpected problems that may arise during the execution of the project, and hence it would consume more amount of time than expected. That is called pessimistic time estimate. Most likely time estimate is made in between these two, optimistic and pessimistic time estimates. So, practically speaking, neither the pessimistic nor the optimistic estimate may hold in reality. It is the most likely time estimate that is expected to prevail in almost all cases. Therefore, now based upon these three estimates, how the diagram is to be constructed. Now, let us take up this problem now. Determination of project completion time under PET. The problem here is given. Find out the time required to complete the following project and the critical activities. So what is given in the problem is, I think it is clear now problem. Activity, predecessor activity, optimistic time estimate, most likely time estimate, pessimistic time estimate. I think clear? Seen on the visible?
Yes, sir. Visible.
Yes, yes. So these are the items given now. Activity name is given, predecessor activity is given, optimistic time estimate, pessimistic time estimate, and most likely time. Three time estimates are given. So we can construct a diagram only when we have only one time estimate. We cannot have three time estimates for an activity. Therefore, these three estimates are to be converted into one estimate. What is given is TO, the optimistic time, TM, most likely time, TP, pessimistic time. So these three times are to be converted into one time estimate. For that, we use this formula. Is it visible on the screen now, the formula? TE. TE means estimated time. Estimated time is equal to TO plus 4TM plus TP by 6. I request you to make use of this formula and find out the time estimate, that is TE for the first activity. TO means optimistic time. TM means pessimistic, I mean most likely time. TP is pessimistic time. So what is given in the problem is the activities are given. So note down this formula first. TE is equal to TO plus 4TM plus TP by 6. Note down this. I will go back to the problem now. Let us complete this task and go. Few more minutes I will take. Take down this formula because you have to calculate and tell me the time estimate now. Take down this formula. T is equal to TO plus 4TM plus TP by 6. Right? T is equal to TO plus 4TM plus TP by 6. Okay. Now, take up activity A in this problem. Activity A. Optimistic time 2, most likely time 4, pessimistic time 6. You find out and tell me what is TE.
Four.
4. Kindly find out for the next one also so that I can scroll down. What is correct? Next one.
6.
Yes, sir. Like that, we have to calculate TE for all the activities. Now see the solution, please. 4, 6, 10, 12, 9, like this, everything is calculated. So another column is introduced, TE. So we calculate the values. These values are to be taken while constructing a diagram. This is how the diagram is constructed. Are you able to follow this? How it is to be done? So when the three time estimates are given, you convert them into one time estimate, take that time estimate and construct the diagram, then find out the critical path as usual. Now you tell me in this diagram, how many critical paths are there? One by one you can tell me now. We have to reach 8 from 1. What are the various paths through which we can reach? So that you can find out the critical path. By seeing this diagram, you can tell me how many paths are there, different ways in which you can reach 8 from 1. I will tell you
4.
now. 1 to 2,
4.
2 to 3, 3 to 5, 5 to 6, 6 to 8. This is one way. Like that, you can tell another way.
1 to 2, 2 to 3, 3 to 5, 5 to 6, 6 to 8.
That is one. Next one.
1 to 2, 2 to 3, 3 to 5, 5 to 7, 7 to 8.
Yes. Next one.
Then 1 to 2, 2 to 4, 4 to 5, 5 to 7, 7 to 8.
One more.
And that's it, sir. 1 to 2, 2 to 3, 3 to
2 to
5.
4, 2 to 4, 4 to 5, 5 to 6, and 6 to 8. So these
5.
are the different paths. You have to find out the critical path. That's all. So this is given here. 4 paths are there. You find out the critical path. 49 days is the completion time. That is the highest duration in which the project is to be completed. So this is about PET. With that, let me stop now and let us continue the other things in the next class tomorrow, please. Thank you very much.
Sir, can you share the study materials?
Sure. I will do it.
Thank you.
Don't worry.
Thank you, sir.